Welcome, welcome, welcome. How's everybody doing? Y'all good? How y'all doing? How y'all doing this afternoon? How many we got in here? Okay, we got a good amount of people in here. Can y'all hear me?
Yes, sir.
All right, cool, cool, cool. Let me make sure we set this up. All right. Um. All right. So we got the chat popping. Okay, cool. All right. So once again, thank y'all for joining. I appreciate y'all for signing up for this course. I appreciate y'all for tapping in the Telegram group. Thank y'all for staying positive. Thank y'all for encouraging each other and dropping information in there. And we operating real good. I really appreciate that. I really do. Um, First, we want to start off, and I know we probably got some new members in here. I want to I want to make sure that y'all are good as far as understanding how to operate with just options in general. Any questions, any concerns, anything you might be stuck on or in the dark about, anything you need help with, go ahead and raise your hand, and we can address that stuff before we get started. Don't know how long this class is gonna be, but you know how I do. I'm just gonna go until I can't no more. So go ahead and raise your hand if you got any questions, and then we'll just do the Q&A right now. Kevin, go ahead.
Yeah, I'm actually new to it at all. New to it all together. I
Mm-hmm.
have been reading some information. I have read information, understanding the calls and understanding the puts, understanding what those terms are, but and understanding, like maybe getting an understanding of a starting point. But I'm just trying to understand like philosophies and things of that nature, how to start, where to begin, what would be a good platform to even start on, those
Yeah.
things.
All right. So for the most part, everything that I'm teaching right now is strictly on Robinhood. So the Robinhood platform is the easiest platform for you to start out with, beginner's platform. Free, no commissions. They throw you a free stock just for signing up. Um, that I would suggest that to start out with because it's easy to work around. But just understand that there's limitations. I know we had some people in the course who got hit with that pattern day trading rule. Just know that, once you sign up, options is not going to be automatically enabled. You have to go into the back end. I'm pretty sure we addressed that on class 1 or 2. So if you go back to the classes, I think we addressed that, how to get that situation worked out. Um, and then pattern day trading. So buying and selling within one day is one day trade. You can't do that more than 3 times within a week. All right. So the trading week goes from Monday to Friday. If you do that more than 3 times within a week, then you'll get hit with a pattern day trading, and they will flag your account and basically halt you from doing anything for like 90 days. I think we had somebody in the chat say a workaround for that, but there is a protection on there to keep you from doing it. But that has been an issue with people in the past because it's not something that they make very, very clear when you're starting out. Just be aware of it. All right. Most of the stuff that we do, we're gonna hold the trades for a couple of days anyway. So you would call that swing trading. Um, we're not necessarily day trading. Most of the opportunities that we have are going to be a few days, if not a week or so. So you shouldn't have that issue, but everybody's doing their own thing. So just be careful with that. But as far as the traditional stuff, the stuff that we about to get into tonight, I suggest having a more traditional brokerage account for that. Again, there's nothing wrong with doing this with Robinhood. Absolutely nothing wrong with it. I know plenty of people who have Robinhood accounts who strictly use Robinhood accounts and nothing else, even when they're using the strategy that we're gonna go over tonight. just be aware of the limitations of just working on the app, because Robinhood at the end of the day is only an app. All right, it's just an app. So if you want more protection and whatnot, I would go with a more traditional brokerage account. Earlier this morning, I did a quick basic demonstration video for Thinkorswim. So that's TD Ameritrade. So they have an online brokerage trading platform, and then they also have Thinkorswim. You can use either one when you sign up with TD Ameritrade. A lot of people like Thinkorswim. It looks super complicated, but I put a video out, and it's in the chat in the Telegram, where I just simplified, just options in general, just real simple. Don't get lost on the platform. It can look confusing, but it's really not. Once you understand it, it is almost kind of even easier to work with than Robinhood. It can be. So, but yeah, I would start out with Robinhood, but there's no limit to how many brokerage accounts you can have. You can have 15 brokerage accounts and just try all of them if you want to. But we focus on Robinhood for the most part. So start out there. Share screen. All right. Anybody else got questions? Are we good?
Thank you, by the way.
Yeah, no problem. All right. Matter of fact, let me.
Yeah, I got a question, man.
Go ahead.
Hey, on the charts at the bottom on my chart, I can't never get to like the volume and what's that, RTI or RTO at the bottom of them.
Oh, okay. So you want your chart to look similar to mine?
Yeah.
All right. Let me pull it up real quick. All right. You see that? Can you see my chart?
Yeah, I see it.
All right. So you see this show indicator legend up top left?
Um,
On the top left.
show
Whatever indicators you're using, you're going to be able to control them from the top left, right under the symbol. Where you
Yeah, where the arrow. Yeah.
You click that arrow. If you don't have volume in here, then you need to add it to your chart. So go up to the indicators up here at the top, click on that, and just type in volume. All right. Just type in volume, and there it is right there. So you could plug that in, and it'll pop up on your screen, and then you can go to the legend on the side and click the little gear symbol.
Wait, hold on. What legend?
The legend on the top left hand. Remember?
Oh, okay.
Yeah. So did you get you click volume, right?
Yeah, I got it on there now. I see where you're coming.
So yeah, then you just pull up the gear, and then you can adjust the settings, the style, how you want it to look, and all that.
Okay, so that got to do with the what's the R? What's that? The R all the way at the bottom?
Oh, the RSI?
Yeah.
So same thing. Go up to indicators and just type you could type in RSI, and it's the relative strength index. So it should pop up just like this, and you click that. Right.
Okay.
And my setting for that is 14 is the length. So
14.
Yeah, click the gear symbol. Length is 14, and then you can change the colors and stuff however you want to. On the volume, my setting is MA length is 20. So, and then the stochastic, if you want the stochastic, same thing. You just go to the indicators, type in stochastic, and then click that. And my settings for that is 14, 3, and 3.
You say 14. Okay. I got it now.
All right. So and then on fundamental analysis class, we basically broke down what all those are. I didn't get into too much detail about volume, but volume can be very important. Just a real quick rundown, just so you can see. This is the daily chart. I'm looking at Spotify. This is this long blue line right here is bullish. The red lines are bearish. All right. So when you see a situation where you got the volume down here and it's looking pretty level, and then you get these big bars out of nowhere, and that's just letting you know what the volume is for that particular time frame. So this is a daily chart. So for the daily chart, you see a big blue bar right here, but then you have to look at the candle, and the candle will tell you exactly what it is. So it's almost like two different layers of confluence, and I guess you could say divergence as well. So if you see something to where it's like a big candle, I'm sorry, a big volume bar, but the candle isn't really like a full candle, then it could be deceiving. But then you can look at this one where it's a big blue volume bar and then a real big body on the candle. That's like a good confirmation for me that there's a lot of buyers. So I know it's about to be an uptrend. Some people use this as entry. Some people use this as basically confirmation to let you know you're on the right side of the market. So you see this big red volume bar here, but then you got this small red candle. That's not enough for me to say that it's about to go bearish, because the candle's so small. It's almost like it's just a lot of volume, but it doesn't mean that it's a lot of seller volume because the body is so small. You feel what I'm saying? So if I scroll down to the 4 hour, same type of situation. It's like, you got a big red bar right here, but then the candle the body is not that big, and the trend is, it's not really giving you a good strong signal that it's about to be a bearish trend. So that's just something to help you with confluence, just putting those things on top of each other so you can know if you're on the right side of the market or not. There are really good strategies when it comes to volume, and we can get into that on another time. But it's good to have it there. Heaven.
Yes, I got a question. Yesterday you put in the chat about the prediction and measurement tool. I wasn't really sure how you use that to see basically the date prediction.
Oh yeah. So if you go over to the left side of your chart, you'll see you'll see the different things that you could put here. Obviously, you have the measuring tool here. Almost like the same thing. It's a little bit more significant when you're dealing with Forex and stuff, but you can still use it for percentages. So I'm gonna get to your question, but just because this is here, let me just talk about this real quick. So in this particular case, we're looking at the price right here, right? And we see that it gained this much. If you want to know the percentage, let's say for instance, you came in right here for an entry or something like that, and you want to know the percentage gain, because we're talking about getting a return on your money, right? So you just pull it up from top to bottom. I mean, from the bottom to the top, and it'll tell you what the percentage gain is. So that's 17% right there. And then as far as the measurements, you will go down here and you will look at date range, price range, date and price range. So in this particular example, let's say, matter of fact, which one was we looking at? We was looking at NEE, right? All right, so I'll pull up NEE and I'll put the fib on the NEE. I went from swing low to swing high. All right. And then I saw that price came all the way down to the 618 level. All right. So I'm looking at where my potential target is going to be. I said conservative target will be at the 100% level at $87.76. All right. So what I'm trying to figure out is how long is it going to take for me to get to that point? This is just a prediction. So all I can do is look at previous price movements. You saw how long it took from price to get from $71 all the way up to $87. And there's no earnings call or nothing in between this period of time. So you could look at the measurement tool and look and see date range. So you say, okay, we want to go from here and we want to go all the way up to here. It took 53 days, as you can see, 34 bars, took 53 days to get from $71 all the way up to $87. So I could take that and I can use this same length to judge how long it's going to take for me to get to my target up here. You feel what I'm saying? So you just going off of what previous price movement told you. All right, so I could pull that up and say, I want to go from here, and that's just saying that if the price turns around tomorrow. If price turns around tomorrow and starts going to the upside, and my target is up here at the 100% level, how long is it going to take for me to get there? So I could say probably around the same length, 53 days or so. So now I know it might take me 53 days at minimum, let's just say, to get to my price target. So now I'm looking at option contracts. If I have an option contract, I don't want to get no option contract that's going to expire before 53 days. I want to get an expiration date that's at least 60, you know what I'm saying, or even beyond, because my price target has to get hit. I have to give myself time to get to my price target. So if I'm using a measurement tool, it says approximately 53 days. So when I'm looking at my options chain and I'm pulling up NEE and I'm trying to figure out which one I'm about to get, and I'm buying a call, I want to make sure that my expiration date is at least 60 days out. So maybe I'm looking at June. Now I'm not going to look at any contract shorter than that, because at that point I wouldn't be giving myself enough time to hit my price target. So that's basically what we're talking about when we're using that tool. All right. Got that?
Thank you.
Yeah, no problem. Rakeem.
Yes, sir. Yes, sir.
Yeah, what's good? What's going on?
Not much. Not much. How are you, man?
I'm good. I'm good. How you?
I can't complain, man. It's good to be a part of the chat.
For sure. For sure. So, what's your question?
My question is, well, right now I'm just watching, man. I'm just learning.
Mhm.
You know, just trying to, get all I can for today, and then just try my best to apply. If anything, I'm always go back to the courses that's available on the website.
For sure. Sure.
So, other than that, I'm just watching and learning from you right now.
All right, cool. Yeah, just make sure you start from the top. And I made it so that you're gonna have unlimited access to the videos. So you can learn at your own pace, but whatever questions you got, you can simply just type it in the chat, or we got Q&A here on the live Zoom calls. But if you get stuck on anything, just let me know. And usually in the Telegram, I've been answering questions with video. If I have to pull something on the chart, I'll do it, no problem. So just making sure just make sure you stay up on everything. There's no need for you to be in the dark about nothing. All right.
Gotcha. And I appreciate it, man. It's a great program. Thank you again, man.
Yeah, no problem. No problem. Your travel agent. I don't know who that is. Your travel agent. All right, well.
Hello?
Yeah. What's going on?
Yeah. What's going on? Hey, what's going on, bro? Hey, I want to get back to you with my question. I'm trying to get home so I can look at it, from the computer, because right now I'm in the car on the phone. And of course, it's totally different what I can see on the phone versus, my questions in which, kind of, I'm just starting out. I want to act as if I'm green all the way, and I just want you to answer a couple of things for me. So, I said I'll raise my hand when I get home.
All right, no problem. We'll be here.
All right, no problem. We'll be here.
All right, so it look like we good on the questions for now. So let's just go ahead and get right into it. All right, so tonight we're going over dividend investing. All right, I know some members in our course who are already keen to this knowledge, already taking action, already know how to operate within this realm. But we have some people who aren't. So we're gonna break this stuff down and get everybody up to speed. So What is a dividend? A dividend is the distribution of some of a company's earnings to a class of its shareholders. As determined by the company's board of directors, common shareholders of dividend paying companies are typically eligible as long as they own the stock before the ex-dividend date. Stocks may be paid out as cash or in the form of additional stock, okay? A dividend is the distribution of some of a company's earnings to a class of its shareholders as determined by the company's board of directors. Dividends are payments made by publicly listed companies as a reward to investors for putting their money into the venture. Announcements of dividend payouts are generally accompanied by a proportional increase or decrease in the company's stock price. Dividends must be approved by the shareholders through their voting rights. Although cash dividends are the most common, dividends can also be used as shares of stock or other property. Along with companies, various mutual funds and exchange traded funds also pay dividends. All right. A dividend is a token reward paid to the shareholders for their investment in a company's equity, and it usually originates from the company's net profits. While a major portion of the profits is kept within the company as retained earnings, which represents the money to be used for the company's ongoing and future business activities, the remainder can be allocated to the shareholders as a dividend. At times, companies may still make dividend payments even when they don't make suitable profits. They may do so by maintain their established track record of making regular dividend payments. The board of directors can choose to issue dividends over various time frames and with different payout rates. Dividends can be paid at scheduled frequency, such as monthly, quarterly, and annually. For example, Walmart Inc., UL make regularly quarterly dividends. Companies can also issue non-recurring special dividends either individually or in addition to a scheduled dividend. Backed by strong businesses, performance, and improved financial outlook. All right, so Microsoft declared a special dividend for $3 per share in 2004, which was way above the usual quarterly dividends in the range of 0.08 cents to 16 cents per share. All right, so basically, what we're talking about is companies, publicly traded companies giving you a piece of their profits at the end of the day. So I think we had somebody in the group ask questions about IPOs and new companies. Obviously we want to be able to jump on those opportunities when a new company gets listed. The IPO makes, the stock price is going to skyrocket right out the gate, and you want to be along for that ride a lot of times. Yeah, you can do that if you want to get that short-term game. If you're in the right spot at the right time, that's great. But as far as establishing a portfolio and putting yourself in a position to where you're getting passive income, new companies are not really going to issue any dividend payments because the dividend payments come from the actual profits of the company. And usually publicly traded companies, new ones, they operating off of debt. So there really is no profit, especially the first few years in business. There's no profit for them to pay out to anybody. So dealing with a brand new company and being a long-term investor for a new company is very, very risky. It's all risky, but it's even more risky when you're dealing with a new company because first of all, you're not gonna get your money back no time soon unless the company stock price just continues to skyrocket. But secondly, they would be considered unstable because they're operating off of debt and anything can happen. You know what I'm saying? You're just gonna have to keep borrowing money. Sometimes it just don't work out. It just is what it is. So what I do is I focus on companies that have a long track record. We're gonna get into that and make it so that it's easy for y'all to see what companies are the best ones to pick when you're dealing with a dividend paying portfolio. All right. So dividend paying companies, larger, more established companies with more predictable profits are often the best dividend payers. These companies tend to issue regular dividends because they seek to maximize shareholder wealth in ways aside from normal growth. Companies in the following industry sectors are observed to be maintaining a regular record of dividend payments: basic materials, oil and gas, banks and financial, healthcare and pharmaceuticals, and utilities. All right. Companies structured as master limited partnerships and real estate investment trusts are also top dividend payers since their designations require specified distributions to shareholders. Funds may also issue regular dividend payments as stated in their investment objectives. Startups and other high growth companies, such as those in technology or biotech sectors, may not offer regular dividends because these companies may be in the early stages of development and may incur high costs as well as losses attributed to research and development, business expansion, and operational activities. They may not have sufficient funds to issue dividends. Even profit-making early to mid-stage companies avoid making dividend payments if they are aiming for higher than average growth and expansion and want to invest their profits back into their business rather than paying their dividends. So that's basically what we just talked about. Important dividend dates. Dividend payments follow a chronological order of events and the associated dates, and the associated dates are important to determine the shareholders who qualify for receiving the dividend payment. So we're going to go over those dates so you know when to invest in those companies so that you can make sure you get paid at the most recent time frame. Announcement dates are announcement company management and on the announcement date and must be approved by shareholders before they can be paid. Ex-dividend date. All right, so the ex-dividend date is the date on which the dividend eligibility expires. Is called the ex-dividend date or the simple X date. For example, if a stock has an X date of Monday, May 5th, then shareholders who buy the stock on or after that day will not qualify to get the dividend as they are buying it on or after the dividend expiry date. Shareholders who own the stock one business day prior to the X date, that's Friday, May 2nd or earlier, will receive the dividend. Record date. The record date is the cutoff date established by the company in order to determine which shareholders are eligible to receive a dividend or distribution. Payment date. The company issues the payment of the dividend on the payment date, which is when the money gets credited to the investor's account. So basically what you want to make sure you want to do is you want to invest in the company before the ex-dividend date. All right, strategically put yourself in a spot to where if you're going to do it, make sure you do it before that date. So that way you can get the immediate return without having to wait, you know what I'm saying, for the next quarter. Because most of the companies that we're going to go over are going to pay quarterly. That's every 3 months. They're going to pay a dividend. You know, if they're on schedule and they're not cutting it, they're going to pay every 3 quarters. So you're going to have to wait a whole nother 3 months. You know what I'm saying, if you do it late. So we want to make sure you do it on time so that you get that dividend payment immediately, and then you can see the growth from there. All right. Impact of dividends on share price. Since dividends are irreversible, their payments typically lead to money going out of the company's books and accounts of the business forever. Therefore, dividend payments impact share price. It may rise on the announcement approximately by the amount of the dividend declared and then decline by a similar amount at the opening session of the ex-dividend date. For example, a company that is trading at $60 per share declares a $2 dividend on the announcement date. As soon as the news becomes public, the share price shoots up by around $2 and hit $62. Say the stock trades at 63 one business day prior to the ex-dividend date. On the ex-dividend date, it comes down by a similar $2 and begins trading at 61. At the start of the trading session on the ex-dividend date, because anyone buying on the ex-dividend date will not receive the dividend. All right, and we'll break that down again just in case. Why companies pay dividends? Companies pay dividends for a variety of reasons. The reasons can have different implications and interpretations for investors. Dividends can be expected by shareholders as a reward for their trust in the company. The company management may aim to honor this sentiment by delivering a robust track record of dividend payments. Dividend payments reflect the positivity on a company and help maintain investors' trust. Dividends are also preferred by shareholders because they are treated as tax-free income for shareholders in many countries. Conversely, capital gains realized through the sale of a share whose price has increased and considered taxable income. Traders who look for short-term gains may also prefer getting dividend payments that offer instant tax-free gains. So for those of y'all who understand that, basically, we talking about trading. we're talking about options trading specifically, you know, every single trade is a taxable event. I know a lot of people have questions about the taxes. Don't stress yourself out about it. It's really not that big of a deal. Yes, it goes by your income, you know what I mean, and where you are as far as what you're making. But also, when you're dealing with dividends and you're dealing with profits from trading, what we're doing is we're pulling money out of thin air. So I don't really understand why people get so hung up on the taxes per se. There's different ways that you can maneuver around that, and you know, different write-offs and all that type of stuff, obviously. But when you pulling money out of thin air, like paying taxes is really not. It really shouldn't be that big of a deal. Get a good CPA. Robinhood, TD Ameritrade, E-Trade, whatever brokerage you're with, they're going to give you a statement at the end of the year. So it's not like you have to track all this stuff on your own. They're going to give you a statement. All right. You can literally just print that statement out and just send it to your CPA or whatever. They should know what to do. But for the most part, I just want y'all to understand, like, if you invested in the company long term and they're paying you dividends, don't stress about the capital gains aspect of it, because the IRS is not going to take all of your profits. They're going to take a little piece, but again, there's going to be write-offs and there's going to be incentives and all this other stuff. And also, there's different vehicles that you can invest in to offset those tax liabilities as well. But just keep in mind, what we're doing is we're pulling money out of thin air. We're making our money work for us. And if you didn't really have to exert yourself to go and get that gain, then don't stress too much about the taxes. All right. So high value dividend declaration can indicate that the company is doing well and has generated good profits, but it can also indicate that the company does not have suitable projects to generate better returns in the future. Therefore, it is utilizing its cash to pay shareholders instead of reinvesting it into growth. If a company has a long history of dividend payments, a reduction of the dividend amount or its elimination may signal to investors that the company is in trouble. The announcement of a 50% decrease on dividends from a General Electric, one of the biggest American industrial companies, was accompanied by a decline of more than 6% in GE stock price on November 13, 2017. So when a company is struggling, like for instance, what happened with this COVID-19 situation, stock prices dropped dramatically. A lot of companies were operating at a negative. They might not have a choice but to cut their dividend. When that happens, if my whole sole purpose was investing in that company because they pay a good dividend, and then they turn around and say that they're not paying it no more, then naturally I'm probably going to sell my holdings, and that's just going to make the price drop even more. So when you see news come out about somebody like a Warren Buffett investing a large amount of money into a company and it's trading at a low value, and you look it up on your chart and you see that the 50 moving average ain't even really crossed over the 200, it's not really on an uptrend, or it's trying to get up there, or even with the Verizon situation or Chevron, yeah, they might pay a dividends and it might not be nothing much, but he's looking at it from the aspect of over time, I'm looking at how much debt they have. We know in the future that they're going to pay down that debt. When you pay down the debt and you got more assets than liabilities, then naturally you're going to have more profits. More profits mean if the company's stable and the management, and I know what the management is about, then I know that they're going to utilize more of their profits to pay their shareholders, because the shareholders are helping bring more revenue into the company so that they can establish themselves and keep pushing forward. So that money's going to come back to you in the future, not necessarily right now. So when you're dealing with long-term investing, that's something that you got to keep in mind. And I'll show you some things that can help you weigh those aspects. A reduction in dividend amount or a decision against making any dividend payment may not necessarily translate into bad news about a company. It may be possible that the company's management has better plans for investing the money, given its financials and operations. For example, a company's management may choose to invest a high return project or invest in a high return project that has a potential to magnify returns for shareholders in the long run, as compared to the petty gains they will realize through a dividend payment. So obviously future outlook, what the company feels about where their money need to go. Yeah, I could pay you right now, but if I reinvest this money, it's going to come back tenfold in the future. Depending on how people feel about that will determine on whether the price of the stock goes up and down, if people are going to stay in it or not. So that's why it's important when we start talking about these earnings calls and stuff like that. The earnings calls are very important because what it does is there's no other way for you to know exactly what's going on with the company until you have that call, because they don't have to make everything public information. But when they have that earnings call, that's when they break everything down for the previous quarter. So the earnings call will let you know, yeah, they predicted that the earnings was going to be higher than last time. And yeah, they might have missed earnings or beat earnings the last time. This time they beat earnings. Everything is good. We're profitable. We made more profit than last quarter. But some of y'all have seen, even with a good report, the stock price might drop anyway. Sometimes if you tune into the actual earning call, you will understand why that happened. Sometimes they might call and say, look, we made a whole lot more money. We beat the earnings estimate by a lot, skyrocketed. But we decided that we're gonna reinvest this money into a future project, and we're not gonna do the dividends this time, or we're gonna cut the dividends or something like that. That will make the price drop. You feel what I'm saying? Vice versa. You know what I'm saying? You might have a situation like Exxon. I invested in Exxon about a month ago. Their situation was a little shaky. People was like thinking that they might cut their dividend payment because of the profit and all the stuff, that it wasn't a lot of extra bread for them to be doing all that. So what they did was they made it so that nothing else mattered. Only thing we worried about is paying the dividends. We want to uphold that because we know that if we pay this dividend, then we know that our shareholders is going to rock with us because they know that we're really not even in a real situation to be trying to force a payout right now. If we didn't pay out, they should be understanding. But since we did, it should make them even want to invest in us even more. So I ended up investing in Exxon before that article dropped, and then they said, "Look, we're gonna go ahead and make sure we pay this money out to y'all," and that actually made the price jump up. So regardless of what the earnings call said, because they made that move, it made the price jump up. You feel me? So that's why the earnings calls are very important. You want to make sure that you stay in tune with that, not just because you options trading, but also when we're talking about growing a portfolio long term. It's important because that's the only way you're going to know what's going on with the inside of the company. A note about fund dividends. Dividends paid by funds are different from dividends paid by companies. Company dividends are usually paid from profits that are generated from the company's business operations. Funds work on the principle of net asset value, which reflects the valuation of their holdings or the price of the asset that a fund might be tracking. Since funds don't have an intrinsic profits, they pay dividends sourced from their NAV. All right, we're gonna get into that too. Due to the NAV-based working of funds, regular and high-frequency dividend payments should not be misunderstood as a stellar performance by the fund. For example, a bond investing fund may pay monthly dividends as it receives the money in the form of monthly interest on its interest-bearing holdings. The fund is merely transferring the income from the interest fully or partially to the fund's investors. A stock investing fund may also pay dividends. Its dividends may come from the dividends it receives from stocks held in its portfolio or by selling a certain quantity of stocks. It's likely the investors receiving the dividend from the funds are reducing their holding value, which gets reflected in the reduced NAV on the ex-dividend day. So basically, what they're saying is, like, when we're talking about funds, we're talking about ETFs, and we're talking about even real estate investment trust. A normal stock, they're going to pay you a dividend based off of the profits that they make. But when you're talking about funds, you're going to have different securities inside that fund. So let's say, for instance, we're talking about S&P 500. It's a 500 companies, you know what I'm saying, listed in that particular fund. They have dividend paying stocks within that fund. If you want to take the easy route, that's fine. You can invest in the S&P 500 for the long term and you'll get a dividend payment from the S&P 500. But what you'll realize is you're actually minimizing the potential profit that you can make, because they're not going to take all the dividends from each company in the fund and then pay you a total amount. They're just going to pay you a fraction of that. Whereas if you invested in those companies individually, you would be getting a dividend payment from each one of those securities. So that's basically what, what this is saying. The dividends are coming from the holdings on the inside of the fund, or it'll come from monthly interest, from the funds. So even with real estate investment trust, they might be taking in rental payments, and then they'll pay you in the form of a dividend, but it's actually not a dividend. It's just a piece of the rental payments that they collect. So that's the difference. Are dividends irrelevant? Economists Merton Miller and Franco Modigliani argued that a company's dividend policy is irrelevant and it has no effect on the price of the firm's stock or its cost of capital. Theoretically, a shareholder may remain indifferent to a company's dividend policy. In the case of a high dividend payments, they can use the cash received to buy more shares. Reinvesting dividends is also a smart choice, though it isn't always the best option. For instance, in the case of low payments, they can instead sell some shares to get the necessary cash they need. In either case, the combination of the value of an investment in the company and the cash they hold will remain the same. Miller and Modigliani, thus conclude that dividends are irrelevant and investors shouldn't care about the firm's dividends policy since they can create their own synthetically. It depends on what, how you want to look at it. To me, I don't think that dividends are irrelevant, but if you're a trader and you're just a day trader and you just trade, then you might think dividends are irrelevant because you feel like you're going to get a bigger return off your own strength. So it just depends on what your investment strategy is, but we learn how to do both. However, in reality, dividends allow money to be made available to shareholders, which gives them the liberty to derive more utility out of it. They can invest in another financial security and reap the high returns or spend on leisure and other utilities. Additionally, additional costs like taxes, brokerages, and individual shares make dividends a considerable utility in the real world. Dividends can help to offset costs from your broker and your taxes. Ultimately, this can make dividend investments more attractive. Of course, to get invested in dividend earning stocks, one would need a stockbroker. So we understand that. Buying dividend paying investments. Why does it keep doing that? Buying dividend paying investments. Investors seeking dividend investment have a number of options, including stocks, mutual funds, exchange traded funds, and more. The dividend discount model for Gordon Growth model can be helpful in choosing stock investments. These techniques rely on anticipated future dividend streams to value shares. I'm going to give you a couple of strategies to look at. To compare multiple stocks based on their dividend payment performance, investors can use the dividend yield factor, which measures the dividend in terms of a percentage of the current market price of the company's share. The dividend rate can also be quoted in terms of the dollar amount each share receives dividends per share. In addition to dividend yield, another important performance measure to assess the returns generated from particular investments is the total return factor. This figure accounts for interest, dividends, and increase in share price, among other capital gains. Tax is another important consideration when investing for dividend gains. Investors in high tax brackets are observed to prefer dividend paying stocks if the jurisdiction allows zero or comparatively lower tax on dividends than normal rates. For example, Greece and Slovakia have a lower tax on dividend income for shareholders, while dividend gains are tax exempt in Hong Kong. All right, so that's pretty much the end of the PowerPoint. Just to break down exactly what dividends is, so we all have an understanding on what we talking about. All right. I see Andreas, you have a question?
Yes, I had a question. So looking at ETFs, and I'm a big fan of ETFs too, and funds sometime when investing dealing with dividends. So if I was dealing with the S&P 500, you was noted that you will only get a portion of those shares. So if you have like Coca-Cola, Verizon, and there's some other companies. They don't give you the dividend of all of those companies. They just give you a dividend of a fair portion of the share of the ETF or the fund, right?
Mm-hmm.
Okay.
Exactly.
Okay. And so if you want to do an ETF, I do ETF because I like it for long term and security. So that's basically what the ETF is for. If you just look and say 20 years from now, I'm gonna keep investing and then see where you at then.
Yeah. So like, exactly. But what you gotta understand is when you hear people like Warren Buffett and them talk about it, like, well, you could have just invested in S&P 500 and you'd have been straight. You'd have beat the market. Basically,
Right.
what he's saying is, if you put your money into an ETF, the ETF is designed to go up. So
Gotcha.
they're only gonna put the strongest companies in those ETFs
Gotcha.
to ensure that the stock price goes up. Not necessarily investing in them for dividends. We're
Okay.
investing in them for the growth. So if
Gotcha.
I just want to grow my $100, I could put my $100 into ETF and know that at the end of the year, I'm gonna get at least 8% of that back. You know what I'm saying? Not necessarily about the dividends, but the dividends would be just a bonus.
Gotcha.
You feel what I'm saying?
Gotcha. Okay.
If you really wanted to get an advantage over everybody when it comes to dividends, it would be smarter to just do it the individual stock way rather than just throwing your money into an ETF.
Gotcha.
Yeah. Hold on a second. How can I gain access to other pre-recorded class? Yeah, so for the people that just joined in, the pre-recorded classes, you want to go to the back end. I could show you that now while we getting into this other thing real quick. So you basically just log in using the same link that you used when you signed up. You just literally go and then click. You'll see the login button. You just click login, and if you haven't created a user account, go to your email, the email address that you use that sign up. I sent you. It's an automatic email that you get sent, and it has instructions in it. Follow those instructions, and then you can create your member account. And when you log in, you're gonna see this in the back end. You literally just click the classes, and you can click on it, and you'll see it. If you're using your phone, and you click on this, you have to scroll all the way down to the bottom to get to the screen. If you're on your phone, the video is gonna be at the bottom. I know a lot of people click on it and it's like, ain't nothing happening. It's because you gotta scroll all the way down to the bottom. That's just the way it's built. So, and then make sure you stay tapped in, the daily technical analysis videos, all the stuff that y'all asked me about in Telegram. I send the video in Telegram, but I also load it up in here too. So, and that's for the people who don't have Telegram. A lot of people that sign up don't rock with Telegram. So this is here as well. And then also the course material, very important. Everything that we discuss and all the stuff that I add in goes into the course material. So today, this is what we're going over right now. So I want y'all to log in to your back end. You can do it now or you can do it later. Log into the back end, go to course material and click on class number 4. All the stuff that we about to go over is already back here, okay? And then I'll update this stuff as we go on. Let me pull up this, make sure I see y'all. All right, so let's see. All right, so we went down the line. Everybody knows what dividends are, right? Everybody has a good understanding of that. Cool. Okay, so first what we want to do is we want to understand that every single stock that's publicly traded does not pay dividends. That's clear, all right? Stable companies that have a good track record, good profit, good growth, those are the ones who you can rely on for dividends. Although a company might start out paying dividends and they might be solid with that for like 10 years, but then something can happen. The industry completely can change. The climate can change. COVID could change the situation to where they can never bounce back from it. Things can happen. People get fired, management, whatever. Come to a point where they have to cut the dividend. Sometimes businesses just file bankruptcy and then you just never hear from again. It's business, things happen. But if you want to get into this game, there's different things that you can look at to ensure that you stay on the right side of dividend investing. So one thing that you want to check out is a list called Dividend Aristocrats, all right? So what are dividend aristocrats? A dividend aristocrat is a company in the S&P 500 that has paid and increased its base dividend every year for at least 25 consecutive years. S&P Dow Jones Indexes, which owns the S&P 500 index, reviews the list of qualifying companies every year and updates the list of companies that carry dividend aristocrat status. Their impressive track record of dividend growth make dividend aristocrats some of the most attractive dividend stocks to own. So basically, if you wanted to make your life easier, you could just focus on the dividend aristocrat list and just grab those. Now, what I'm gonna do is, or what I've done is in the back end, I've already given you a spreadsheet full of the dividend aristocrats for this year. I'll pull it up right now so we all can see it. And the prices that are on here, obviously, the prices have changed since I put it on here, but this will just give you a gauge on what we're talking about. All right. So it's February, the end of February now. So you'll see that the next scheduled dividend payout on this side right here. So you know when the next one is coming. And then the ex-dividend date, basically what this says is, as long as you invest in that company before this date, you're guaranteed to get the next dividend schedule. Obviously, these dates are off. We have to update this list because I put this up here when I first started this course. So you see the companies that are on here: 3M, Coca-Cola, Colgate. You know what I mean? A lot of these companies we are familiar with. A lot of these companies we're not familiar with. Look at the companies that are listed. Okay. Also, I have the link on the Motley Fool website, so you can click the link and you can look at the company and their information on Motley Fool. These are the sectors that they're in. So all different sectors: healthcare, industrials, consumer staples, real estate, financials, energy. All right. It's this particular list has 86 companies on this list. All right. So 86, all these companies have paid, you know what I'm saying? They don't have no problems with their revenue up until this point, no problems. The dividend payment, dividend yield, the percent, this is what we shooting for right here. As of right now, when we start building a portfolio, we want to make sure that we have a significant amount of dividend yield so that we can guarantee that we have the ROI that we're looking for. All right, because we all want to get a return on our money. We want our money to grow. So the strategies that we have with technical analysis will show you how to enter into a specific security or stock at the right time so that you don't come in when the price is about to drop, so that you buy on the dip, so that you make sure that you're on the right side of the market. Okay, so if you get in at the right time, not only will you experience the growth in the actual stock, but you also will get a double whammy with the dividend yield, and that's like an extra payment on top of that. Okay, so dividend aristocrat list is something that you should check out. The next thing we want to talk about is dividend kings. All right, what are dividend kings? Dividend king is a category of the S&P 500 companies with extraordinarily long records of consecutive annual dividend hikes. The specific requirements for admission to this elite group of dividend-paying companies is simple. To earn the Dividend Kings moniker, an S&P 500 company must have a market capitalization of more than $3 billion and a record of raising annual dividend payout amounts for at least 50 consecutive years. Dividend Kings is an impressive subcategory of the dividend aristocrats designation that has same market cap requirement for S&P 500 companies, but require only 25 years. So the last list we looked at, you had to do it for 25 years to get on that list. For this list, you have not only have to get on there for 25 years consistently, but you had to have growth in your dividend payout. So that means that they might have been paying 1.5% yield, and it worked all the way up to 3.5, 5.5%, 4%. You feel what I'm saying? So you get on one of these companies, now you're looking at not only getting in at the right time to experience that growth, but also holding it long-term knowing that you're going to probably have a good chance of getting an increase in your dividend payment as a shareholder. So here's the list. Did I have this? I think I had this in the back end. Let me check again real quick. Dividend Aristocrat, Dividend. Okay, boom. Dividend Kings right there for you. All right, so this is 30. It's 30 companies on this list. All right, so you see, obviously all these companies were already on the previous list, but it's a shorter list. So if you wanted to be more strategic about it, you can just stick to companies on this list in particular. And then you have the dividend yield here. And you see I highlighted the ones with the highest. All right, we got a company on here, Altria Group. They're paying an 8% dividend yield. One thing you have to be very careful with, when you're dealing with companies that pay an extremely high amount in dividend, it can be risky. You have to do your due diligence, because what happens is when the stock price drops dramatically, the dividend yield will rise. And that is for multiple reasons. One of them is to attract people to buy the stock, because we want people to buy in for, we got to give them a reason to invest at the end of the day. So if they see that our share price is dropping, what is going to incentivize them to continue to give us money and invest in our company? We got to push this dividend payment up to at least attract people in here. And then as more people start buying in and the stock price continues to rise, the dividend payment can actually shrink to a normal rate. But another reason why is you have to look at the actual ratio, the PE ratio. All right, so we'll pull that up. PE ratio, price to earnings ratio. This is how you determine if the company is actually cheap or not. The main goal of a business is to turn profits. Earnings is just another word for profits. All right. So what you're doing is you're looking for a company that has a reasonable PE ratio. All right. Anything above a 25% or 25 ratio and up is risky. So what you'll find is companies that have a very high dividend yield, you have to check their PE ratio, because what that'll tell you is how much of their profits are they using to pay these dividends. If I own a company and I have $1 million in profit and I'm using 80% of that to pay dividends, that's not good. That's not good, because you need profits to continue to operate the company and continue to grow the company. If you're paying all of your profits to dividends, then that's basically what you're saying is you're not really worried about growing the company right now. You're more concerned with keeping your investors happy than actually growing the company. So you want to make sure that that PE ratio is right, because if that number's too high, then that lets you know that they're doing too much. They're doing too much. I need it to be stable enough to where you ain't even got to pay a large amount of your profits to your dividends, to your shareholders in the form of a dividend, and it's still a good, reasonable yield. You feel me? So you want to have the best of both worlds. I don't want the company to be stressing to pay me a dividend. Now, with the example I did with Exxon, I mean, at the end of the day, it's Exxon. You feel me? It's on the list. So I'm not really worried about them long term. But at the end of the day, I know how to trade. I know how to get in and out. So if I see some trauma ahead, then I know how to maneuver and get myself out of that situation. But as of right now, the dividend payments are so good that I want to put my money somewhere where I know that I'm gonna get a high return, and I invested at the right time, so I got that growth anyway. All right, so just so you understand that. All right, so PE ratio is important. Let's see. So we did dividend kings and we got dividend aristocrats. All right. I hope everybody on this call is familiar with Warren Buffett. Everybody should kind of understand who that is. Everybody should be a little bit educated or aware of who that guy is. Very good person to track. Just to give you a quick breakdown on him, Warren Buffett He's noted for introducing the value investing philosophy to the masses, advocating investing in companies that show robust earnings and long-term capital growth. The drill down on his analysis, Buffett has identified several core tenets in the categories of business management, financial measurements, and value. Buffett favors companies that distribute dividend earnings to shareholders and is drawn to transparent companies that cop to their mistakes. So obviously, we want management that we can trust, management that owns up to their mistakes and is willing to do what's necessary to make sure that they rectify them. I need them to know, I need them to pay me dividends, and I need to see that there's growth available in the company. I don't want to buy into a company that has reached its peak already or is overvalued. I want to buy a company that's undervalued, that's paying dividends, that has growth in the future, and the management has a track record of being solid. Basically, is what he's looking for. All right. Just to give you a good outlook on where he's at as far as his dividend investing. As far as 2021, Warren Buffett is projected to collect $3.8 trillion in dividend income just this year. So that's straight up passive. All right. That's just passive. That's money that was that billion. Okay, 3.8 billion. I'm sorry. 3.8 billion. That's passive money. He don't have to do nothing. You feel me? Because of the way he invested, the timing that he decided to invest, and the companies that he did it with, and the dividend yields that they projected to make. That's how much money he's projected to make in 1 year off of just straight up passive money. And obviously, we're talking about Berkshire Hathaway and their holdings. So for people who might be an amateur at this, and it's like, man, this is too much. I don't want to have to deal with picking these companies and doing all this research and trying to figure out if I'm doing the right thing or not. I don't want to get lost. I don't want to make a mistake. The simple thing for you to do is to go to a site like Yahoo Finance and look at the watch list, and they'll tell you what Berkshire Hathaway's portfolio is. It'll tell you all of the companies that they're invested with right now. So you got the Dividend Aristocrat list, you got the Dividend Kings list, and then you got Berkshire Hathaway's list. If you wanted to do this, you could just pick companies off of those three lists, and it's almost like you can't lose. But utilizing your fundamental and technical analysis, understanding that you want to stay on track with the earnings calls, and you want to make sure that you're charting this stuff out so that you enter at the right time. All right. Just to backtrack a little bit, class number 2, where we talked about risk management and we talked about budgeting and making sure that we have a fund and making sure we have the money available to do these things. What we're trying to do is we're trying to put ourselves in a situation where we're creating money out of thin air by getting the growth off of the trades that we make with the options trading strategies. So when the earnings calls come up and we take a risk and put our money into a company and we win and we see profits, we're able to take those profits and we're able to start growing a long-term investment fund with those profits. Okay, so let's just say, for instance, we had some people on here, I guess a week or two ago, who made over $1,000 in profits using the options trading strategy. That $1,000 worth of growth can go towards companies on these lists that we just talked about. So what I suggest is put your money aside, stack it up, and strategically invest in these companies to where you're getting 100 shares at a time. All right. If you can't do that and you get 1 or 2, 3, 4 shares at a time, fine, do what you got to do. But what I suggest is keep using the options trading strategy, because one contract is 100 shares. So when we talked about the strategy a couple of days ago, when we're doing these cover calls and cash secure puts, that $1,000 gain could have went to a company that's on this dividend list. So this list right here is an example. This list right here is a list of companies that have expiration dates on March 19th that all pay high dividends and they all pay high premiums. All right. Everybody should understand what that means. Basically, what that means is if you purchase a contract for one of these companies using the collateral that you already have in your investment account, in your brokerage account, Robinhood, whatever the case may be, you're going to get this bid price right here. That's upfront money. So whatever this number is, multiply that by 100. You're going to get that up front. Okay. All of these strike prices are in the money. So what that means is, I'm sorry, all these strike prices are out of the money. So what that means is if the share price expires and it's still above the strike price, then that means that you don't get the shares. You just keep the premium. But if you want to actually invest in these companies, what you want to do is you want to get a strike price that is a little bit close to the actual share price. So that way, when the actual stock price increases or decreases, or whatever the case may be, you get exercised and you actually take on those shares. So the premium that you get will offset the amount of money that you have to put into buying them, but also you'll put yourself in a situation where you'll be able to take on those gains or not. But what you want to do is you want to get paid up front to buy the shares. That's one way. Another way to do it is using just a regular a regular call. So if you think that the stock is going to go up, then you buy it at a strike price that's lower than the current share price. And then if you're right, the price goes up, you exercise the contract. So we haven't really talked about exercising the contract or not, you know what I'm saying? But you will exercise the contract. Once you exercise the contract, you take on those shares and you purchase them at the strike price that you agreed to. So you have to have the money in your account, obviously. But when you exercise them, you take on those shares and you get the gains that it actually happened. So that's how I bought my my Exxon shares. Let me see if I can pull up my contract on Exxon. So with Exxon, I actually purchased those shares at a good time. All right. So look, I had my chart out. I knew that I was going for Exxon. Why did I decide to invest with Exxon? Because they're on the Dividend Aristocrat list. All right. They were on the Dividend Aristocrat list. Where they at? Exxon was here. Somewhere on here. There you go. Exxon, 61 on the list. They paid 7.2% dividend yield at that particular time. So I was going for them. All right. Share price was at $47 at that particular time. All right. I caught it at 45. I got a $45.50 strike price right at the dip. All right. So I put the Fibonacci retracement tool on it. Okay. Using the strategies that we talked about a few weeks ago. Price dropped all the way down to the 618 level, started working its way back up. I put my contract in right here. Price went up, I exercised the contract. I took on the 100 shares. I got all of that gain, which is like, I'm probably up like $500 or something by now, over $500 gain. Plus I'm getting those dividend payments. So when they pay out the next dividend, I'm getting that too. And from there, I'm waiting for it to dip again and I might buy it again. I wait for it to dip again, I buy some more. Now, once you actually take on those shares, the next level of that, somebody mentioned this in the Telegram again. What is drip? Now, if you have a Robinhood account, the drip is there for you. Any other brokerage account you with will also have this feature. What is the drip? The drip is a dividend reinvestment plan. It's a program that allows investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. Although the term can apply to any automatic reinvestment arrangement set up through a brokerage or investment company, it generally refers to a formal program offered by a publicly traded corporation to existing shareholders. Around 650 companies and 500 closed-end funds currently do so. So with Exxon, I turned on my drip. So when they pay that 7.8% yield, if it stays up that high, it's going to go right back into buying more shares automatically. So my position is just going to keep growing and growing and growing. All right, I'm gonna pause for a second because we got some questions real quick. I'm new to all of this, where there'll be a minimum to invest to get the dividends. So as far as how much money you need to invest in dividends, this is why I introduced the options trading strategy first before we started talking about this. If you understand how to trade options, if you don't have enough money to buy shares, you can use the options trading strategy to grow your money. Then when you have enough money, you can also use the options trading strategy to buy those shares at a lower price than where it's actually trading at. It doesn't matter. So we can use an example when we're talking about ExxonMobil. ExxonMobil right now is trading at $52.54. It doesn't matter to me. I can buy them at $38. It's gonna cost me a high premium. You know what I'm saying? I'm gonna have to pay that. I'm gonna have to pay $1,400 out the gate. But if the strike price, if the share price goes up to $60 or $70 or whatever the case may be, it's up to you. You know what I'm saying? It's up to you. I wouldn't advise you to go that low in the money because that's a little risky. But what I'm saying is you have the opportunity to purchase those shares at a lower price, regardless of what you're trying to do. There's just a sacrifice of paying a premium up front. But if you understand how to trade and you understand how to chart, you can put yourself in a position to do exactly what I just did. I bought at the dip. It couldn't get no better. It couldn't get no better. Maybe I could have bought right at the 618 at $44 instead of $45. But come on, man. This is a perfect trade right here. Perfect. So you all have the access to this and you all understand how to do this. And if you're not able to execute, then you use the options trading strategy to put you in position to where you can continue to grow your money so that you can put it into these long-term investment vehicles. Just to pull up a list, if we look at the Dividend Kings list, you know, the cheapest company on this list is $23.40. All right. So like I said, I would advise for you to invest in at least 100 shares at a time. So that will put you at around 2,300. So it costs you 2,300 to get 100 shares of Farmers and Merchants Bancorp. But they pay a 2.91% dividend yield, which will put you on track to beat inflation, which is important. Plus, you can just stick with this company and just trade it until you get enough money stacked up to purchase 100 shares. But once you get them, you got them. Now you just keep reinvesting. You know what I'm saying? Plus, you're going to get the gains on top of that because you bought at the right time. You just keep reinvesting and you just never sell them. As long as they stay on this list right here, you just keep them forever. All right. Kevin, if you got a question, go ahead and raise your hand. If y'all got questions, go ahead and raise your hand. All right. I'm new. How do you buy a contract? Yeah, that's on class number 1. So you need to watch class number 1. Your travel agent. You have a question?
Yeah, I'm still trying to get home to get back with you, but I got just, you know, I'm real thirsty, you know, and I already got money on the platform Robinhood. So the thing I wanted to ask you, you know, if I wanted to, you know, I wanted to jump in the water and try to swim tomorrow, right?
Yeah.
What are the 3 most important things that I need to be aware of before, you know, making a move?
As far as options trading, you want to make sure that you are looking at the events because you need movement and price.
You need movement and price.
All right. if you want to make some money, if you want to have a good return on your investment, you need the price to move significantly so that you can get that gain. Focus on earnings calls specifically because on earnings calls, price is going to move. It's going to move up or it's going to move down. Very, very rarely will you ever see a stock stay the same or consolidate during an earnings call period. It's going to go up before or after during the call. So we focus on earnings because you potentially put yourself in a situation where you make hundreds of thousands of dollars within a 1 or 2 day period.
Where do I get these numbers from for this earnings call?
Yeah, so you all right? So you're new. So you're new. First class.
Yeah, I'm brand new.
Yeah, very first class. Just go over the very first class. Just go over the very first class. You wrote all that stuff down. All the
Okay, very
information is
first
there.
class.
All the information is there.
Okay.
Yeah. So if anybody got questions now, go ahead and ask them because I already opened that up. But I do have another thing we want to get into. I'm giving y'all another strategy.
Okay, I have a quick question.
Go ahead.
My quick question as far as the ex-dividend time that you said that we could invest in order to get the premium. If you already have your initial investment in at that time and you continue to invest, does that matter at that time, or is just the initial investment at the time before the ex-dividend date?
Yeah, so as long as you have to actually own the shares. So as long as you actually own those shares before the ex-dividend date, then you're guaranteed to get paid when the dividend payout comes. Is that what you mean?
Yes, that's exactly what I meant.
Yeah. So as long as you actually own those shares. Now, if you have an option contract and your expiration date is before the ex-dividend date or something like, that's not going to guarantee you those dividends. You feel me? Because you also have to worry about clearing it. There's a clearinghouse and all this stuff that has, like, you'll find that if your expiration date is on a Friday and you exercise your option on Friday, those shares might show up in your account, but they might not get processed until the following Monday. So that is not going to guarantee that you're going to get them. You got to be in position a couple of days before that ex-dividend date to guarantee that you get those get that credit.
Okay. Awesome. That's exactly what I wanted to know. Thank you.
All right. Yep. So here's a quick one for y'all. We went over this in class already, but the spreadsheets, right? So the spreadsheets that we're talking about will give you the opportunity to get cash up front, and then you can actually get the assets later. That's using the naked puts. So I'm pretty sure everybody pretty much knows how to do that. But we can run through that real quick. All right, so we got use the Dividend Aristocrat spreadsheet to choose companies with the longest consecutive payments and highest dividend yield. You can also use the Dividend King spreadsheet, all right, so that you know that the dividend payments are increasing over a long period of time, all right. Also use reputable sources to note the fair market value of the stock. We're gonna get into that too, all right. Naked put option list for highest bid premium payments, all right. So I put that list, I put a few of them in the Telegram group. I'm probably gonna drop one every week or so, or every couple of days or whatever the case may be. But high premium payments that will get you money up front, basically for your money, all right? So you wanna purchase a cash secured put option contract for companies you wanna invest in that pay high yield dividends, all right? You must have the selected contract's price times 100 in cash as collateral. make sure the expiration date is before the company's ex-dividend date, like we just spoke about, all right? To make sure you actually get them in time. So you collect the premium up front. If the stock price, if the stock price is below your strike price, more than likely the contract will be exercised. You'll collect the 100 shares at the strike price. Then you'll initiate the dividend reinvestment plan to compound the interest, and you keep the premium in cash. If the stock price is above your strike price, more than likely the contract will not be exercised, and you would keep the premium, and then you turn around and write another contract. So I'm gonna give you an example using the Robinhood platform, so you pretty much know how we're gonna do this. So we can do this from top to bottom. All right. Right now we're looking at the Dividend Kings list. All right. Let's just look on here and see what company we want to mess with right now. Let's just use let's use 3M. All right. They pay a good at 3.19%. It's a little expensive. You feel me? But this is just an example. So matter of fact, that's too expensive. Let's be a little bit modest. Trying to find a good price with a good. All right, let's try this. Let's do LEG, okay? $42.50. Dividend yield is 3.67 when I had this printed, when I had this made. All right. So we pull up LEG on the options chain. All right. And we'll see the options chain here, okay? Now let's look at the ex-dividend date. The next scheduled dividend is on April 15th, okay? Let's just say, for instance, the ex-dividend date is coming up and we got time. So we pull it up in the options chain and we see where we at, all right? We can put it at April to make sure that we got them before the actual X date, all right? So let's look at what we're doing is we're selling a put because we already got the money available. All right, we already got the money available. What we want to do is we want to say that LEG, not only do we want those shares, we want to get them, but we want to make sure that we get them in a time frame to where we think the price is actually going to go up. So let's just say we saw this on the dip and we buying at the dip. LEG about to take off. We want to get in position and take advantage of that takeoff, or we want to just buy it regardless. All right. So our price target on LEG might be like $50, or let's say it's $60. We think the price gonna go up to $60 by April 16th. All right. Right now it's at $42.96. We know that the price is gonna go up to $60. If we purchase out of the money put, which means that we have $4,000 in our account and we want to buy 100 shares, we will select this contract and they'll pay us $135 up front. But if the share price actually hits our target, we're not going to get these shares. Nobody is going to sell these shares for $40 per share when they're worth $60 and they already paid us money up front. Nobody's going to do that. So this contract is not going to get exercised. You'll keep this money and you'll keep the $4,000, but you won't get the shares. So we know that the price is going to go up to $60, right? So let's just give ourselves some cushion and say we're going to buy this contract instead. We're going to buy the $55 strike price. Because if the price actually hits our target, it's still close enough to where the person that owns these shares, they might let them go. They might let them go. We already got $5,500 in collateral, but along with that $5,500, they're gonna pay us $1,270 up front. So we're gonna collect $1,270 up front, and we're gonna bank on us actually taking 100 shares, and then we're gonna experience that growth as well. Same thing if we bought a $60 price. If price hits our target, cool. It's almost like I bought them at market value anyway. But the advantage is I got $1,765 up front though. And then I get the shares on top of that. And the price might continue to rise up above 60 because it might be bouncing back from COVID and I'm just catching it in the middle of that growth. So that's a strategy that you could use. Let's just say, for instance, you think the price is going to go up, but you really don't want the shares. You just want to take advantage of the premium because you see that the premium is paying. Let's use an example with the actual list. Last week I did an example with I forgot the crypto, the Bitcoin company, the blockchain company. We can do something else this time. Let's do let's say we want to get premium and I'm trying to get a return on my money. So percentage return is over here, right? Potential return right here. So let's just say I want to put myself in a position to where I'm getting an 8.9% return on my money. Matter of fact, I want to get a 14% return on my money, potentially. That's a pretty good return right there. So you mean to tell me that if I get a contract with this company right here, they're going to pay me a 14% return on my money? All right, let's look it up. This is just how you make cash flow. You don't necessarily have to take all that extreme risk. You can just get cash flow if that's what you want to do. As long as you have the money available, you can make it happen. Let me put that list up again. Expiration date on that was March 19th. March 19th. Here we go. So that was an $8. Was that $8? What was that? 14% return. $9 strike. $9 strike price. So the price actually has went up since I printed this out. So this particular contract, you'll get paid $180 up front. All you need is $900 in your account. All right. If the share price goes up, then you just made cash flow for nothing. If the share price stays where it's at or goes down, you'll get exercised and you'll actually take on those shares. But they pay high dividends though. So you're really not losing. You feel what I'm saying? Does everybody understand that? Yes?
Yes.
Got that?
Yes. Got it.
Okay.
Got it.
Cool.
Yes, got it.
So this is a way for you to make cash flow. So this list right here, and I get these lists every day. Let me actually pull up bar chart. See what's going on for
So the buy and the sell is the same for put, right?
Nah, so as far as puts, if you're selling the put, you have to have the collateral in cash. Whatever your strike price is, you have to have that times 100 in your account. If you're buying a put, you don't have to have the cash available. What you're doing is you're banking on the company decreasing in price and you're profiting on the way down. So you're shorting the stock. You don't need to have the cash. You just have to have enough to pay for this premium right here, whatever this price is. Feel me? So if you think GEO is going to drop before March 19th, then you will get an in the money strike price, and then you'll profit it by the share price dropping. You got that? You don't get no shares.
Okay, I got it.
Okay.
So you get the shares for the sale.
You only get the shares for the sale if it expires in the money.
You get the sales and the premium, correct?
You get the shares and the premium if the share price expires above or at your strike price.
Got you. Okay.
All right. Anybody else got questions about that high dividend? If we can look at the list right now, let me see. Matter of fact, let me make sure we set filter, expiration, boom, boom. All right, so this is a list that I use when I'm just trying to make cash flow. I don't even want no shares. I just want to make money because I got some money sitting in my account, and I wanna make sure that I get a return on my money. I ain't really trying to do too much, so I'm tracking these particular stocks, and I want to make sure that I'm getting paid off of my off of the money that I just got sitting in my account. So depending on how much money I got sitting in my account, what I'll do is I'll find bid prices that are paying over $100. I'm not messing with nothing that's paying me less than $100. All right. So, and I'm looking at potential return. All right. How much of a return am I trying to get? Feel me? I can get anywhere between 10% to 2%. You feel me? And depending on what the time frame is, expiration dates for Friday and beyond. So I could do this all week. As long as the share price expires higher than my strike price, I could just keep my money moving over and over again. And then if I'm ready to actually invest in something, I have another list that I can look at that will allow me to screen all of the companies that pay high dividends and high premiums, so I can get the best of both worlds in case I get exercised and my prediction is wrong. So if I'm wrong about what I feel like the stock is going to go, and I actually get exercised, I'm not tripping about it, because at least they pay high dividends. And at the end of the day, if I wanted to get rid of them, all I have to do is turn around and do the same thing. So just to say, for instance, I actually got exercised and I had to take on this GEO 100 shares. I could keep them, or I could turn around and write a call, sell a call, and sell them for more than I bought them. So my strike price was actually at 9. I might want to let them go for 10. If I let them go for 10, they're going to pay me $5 up front. And if the share price actually reaches that or stays below, then I'll get executed. And they'll take my shares, and I'll make the money off of the growth, the spread, plus the $5. It's not a lot, but depending on what your actual security is, sometimes you actually make money writing covered calls more than you would writing puts. It just depends on what your security is. But that's why these screen lists are important, because I'm able to see them before I jump into the options chain. I can scope them out like that. All right. Everybody understand that?
Quick question for you. Do you make these screen lists available to us as well?
Yeah, if you want them, you just gotta let me know.
Yeah, I definitely want them.
All right, yeah, just let me know. I'll send them. I sent a few last week, but the prices change and whatnot. But it'll help you see what's available. So it's for naked puts. So let me get back to the business real quick and make sure we covered everything. So REITs, what you'll find is about REITs, right? Very important. So what we're talking about here is we're talking about putting ourselves in a position to where we're getting passive income over time. All right. Dealing with REITs, very good investment. All right. REITs are true total return investments. They provide high dividend yields along with moderate long-term capital appreciation. Look for companies that have done a good job historically at providing both. Unlike traditional real estate, many REITs are traded on stock exchanges. You get the diversification of real estate provides without being locked in long-term liquidity matters. So for those of y'all who want to get into the real estate investment business without having to take on all the risks that real estate investors have to take on, you can invest in REITs, real estate investment trusts, and get the same benefits of owning a property as far as the cash flow without having to deal with the liabilities aspect. So some of us, they're like, all right, I want to invest in real estate because I actually want to own the equity. I want to be able to sell the property or or dip into my equity and, you know, get a line of credit off of that or whatever the case may be, this might not be for you. But for those of y'all who want to own real estate, but don't want to have to deal with all the extra stuff, investing in real estate investment trust is the best thing for you because you still get the cash flow. So like I said before, when you get paid dividends from real estate investment trust, not only are there normally larger dividend yields than regular securities, but they pay you those dividends through the cash flow of the actual property. So there's different types of real estate investment holdings that each investment trust has. You'll be dealing with companies that have shopping centers, grocery stores, hotels, you know, any commercial properties, residential real estate. They'll have mortgages. So there's actual trusts that have mortgage holdings, like literally mortgages, mortgage contracts that are cash flowing, and you get paid off of the cash flow from that mortgage. And they have them pooled all together into a trust, and you get to take advantage of that. Hospitals, you know, all of these different assets will be pooled into a particular real estate investment trust, and you'll be able to get some of that cash flow through a dividend payment. So you'll see some of these real estate investment trusts are listed on the aristocrats list and as well as the dividend kings list. All right, I can pull a few up now. This one, Realty Income Corporation. This is a real estate investment trust. $59 share price right now, or when I did this spreadsheet, 4.8%. That's pretty big. But they have investment trusts that pay like 11, 12% that are not on this list, which could be kind of risky, but they're doing great. All right. I'm gonna give y'all another gem right now. Definitely do some research on real estate investment trust. All right, very important. Some people actually have a portfolio where they only have REITs, strictly REIT. They don't invest in nothing else. All they do is just straight up real estate investment trust. That's it. Real estate, that's it. And they got the highest dividend premiums, and they're getting 10, 20% return every single month. A lot of these trusts pay every month, not every quarter. A lot of these trusts pay every single month. So if you're talking about getting monthly income, then real estate investment trust could do that for you, depending on which ones you invest in. So I want y'all to check this out, right? Yes, we do a lot of our research on Yahoo Finance, okay? When we're looking up particular securities and stuff, we pull up Yahoo Finance and they're gonna give us, you know, everything we see up here and the financials and all that. All that is cool. It's easy. You know, I like it because they got like the little channel and stuff. You can listen to it and everything. If you want to take it to the next level and make your life easier and really look at this like a real analyst, because Yahoo Finance is free and it's limited with the information that they're going to give you. Sometimes you try to pull up the financials and they're not going to tell you everything unless you get the premium and all that. They give you a little bit, but if you really want to look at this with an easier eye, check out simplywallstreet.com. All right. I'm sorry, simplywall.street. I'll copy and paste it into the chat so everybody can get it. Simplywall.street. When you're dealing with this website, it makes everything so much easier for you because you can not only can you create your own screener to get to exactly what you want, but it'll show you all of the stuff inside of the company, and it gives you more than what Yahoo Finance will give you. So if you wanted to use an example, let's say we wanted to look at real estate investment trust. Let me see if I can do that. Let me see if they'll do that for me. Yeah, I don't know if they'll do that for me. Let's just see what they got. All right. So Everything is sorted out here. We're talking about buy the dip. We all understand what that is. All right. High growth, undervalued. All right. Insider trading, something that's very important because insider trading basically lets you know how people that are inside of the company feel about the company. When you start seeing a lot of insider trading going on within the company, that means that they know something that you don't. And the long-term outlook on that company, it might be a move that's coming up soon. They want to take advantage of it. You can catch on. You can be along for that ride as well. So that's important. Dividend rock stars lets you know the companies that are paying good dividends and have growth. Upcoming dividends, very important. So you know that the announcements are coming up for what they're paying and how much they're paying. Undervalued tech stocks, defense stocks, consumer staples, very important. Intelligent investor. Has anybody actually read or purchased the book that I listed on our recommended book list? The Intelligent Investor. Has anybody read that book? Type a 1 in the chat if you actually read it or at least bought it. Let's see. I'm looking for real estate. Hopefully they got a list on here for real estate. Okay, we got somebody in here that did. So you see all the list, top dividend players here. All right, undervalued dividend payers. So this might be a diamond in the rough for you. Every company on this list pays at least 2%. And then if you get it and it's undervalued, that pretty much lets you know that you are in line with one of the things that Buffett looks at when he's starting to grow his portfolio. Undervalued companies that have a potential for growth in the future, that pay dividends. Now you just have to look at the management. So let's say we look at this one as an example, and this is what it looks like. So when you see these circles right here, that's called a snowflake. So you can look at it and you see dividend, value, future, past, health. You see it's pushed over to the side where there's dividend and health. That's good right there. All right. What you want to do is you want to get yourself in a position to where you got good dividend, good health, good value, good future, good past. Very rarely are you going to get all of that. It's just almost impossible for you to get all of that. But you want to get more on the side of what you're looking for. So right now we're talking about dividends. We're talking about health. Those two are very important because I know you paying my dividends, but is the company healthy or not? If the company ain't healthy, then I don't know if that dividend is going to be stable. So dividend plus health is great. If you can have some future or growth on that, then we really doing good. All right. So we're looking at let's just pick one. Let's pick one. Investco. How about that? Look at Investco. Okay. We pull this up. Executive summaries here. All right. You see what they have. Risk analysis is here. You pull up the risks and they'll tell you what the risk is. All right. So you know that. Scroll down, you see what the other companies are similar in the sector. Okay. So you can compare, contrast. All right. Latest share price, return 7 days, return in 1 year. 7 days, not so much necessary unless we're looking for entries, obviously. So that's important, but not so much. 1 year return, very important. So you see the returns. So this is basically telling you if you would have put your money into this company, this is the return that you would have got. If you would have invested in this company last year, you would have got a 28.5% return on your money. Then you got the Wall Street news here. You got some news here. Valuation, all right, 50% undervalued, okay? Current price is at $22.40. They think the fair value is $44.89. All right, so you know you're gonna get value when you're dealing with this company, okay? Price to earnings ratio, we talked about that. So the price to earnings ratio is 19. All right, everybody else in their market is around like 23. So like I said, if you anywhere 25 and under, then you okay. Anywhere over 25, then it might be a little risky. So you good on that. Price to earnings ratio is good. All right. Future growth predicted a 31.9% growth in earnings. All right. So that's great. All right. Compared to the industry and the market, they're even better. Okay. Even better. That's just for the year. All right. Return on equity, always good. Past performance, not so much, but we talking about the past. We want to know, we're looking at the future right now. So past, not so much, future is looking good. Return on assets, all this stuff is good. Financial health, assets, liabilities, that's crazy. Normally what you see is it reversed, but this is crazy right here. Assets over liabilities, definitely good. Balance sheet. Now, when you look at the balance sheet on Yahoo Finance, it can get confusing. But you're really only looking at certain things. You pull it up on here, and it's so much easier to look at. All right, so you can see where it's at, and then you see where they lacking. So you see the debt is at 2.2 billion, which isn't so bad compared to everything else they got going on. But that's the balance sheet. That's make it simple for you, so you could just see it. All right, the dividend is at 2.76%. But they're saying that it's going to increase. It's predicted to increase. Not crazy, but you're looking at growth and you're looking at stability. So this 2.7% is stable, but the growth is going to come, and you might have an increase in dividend along with the growth. All right. So we're talking about getting ROI plus passive income. All right. So this is management. Now you can look at the management and see what's up with the management. All right. Same dude been working at the president, chief executive officer for 15 and a half years. This is how much he's been getting paid. Crazy. Now you can look at the leadership positions and see everybody else that's in the company, and you can actually pull up their profile and see what they're all about, you know? So that's part of what Buffett does when he's looking at the history of the company and the management, seeing if he can trust these individuals to own up to whatever mistakes that they done did and to rectify any mistakes that might come in the future, plus their compensation and how stable they are within the company, how long they've been working in the company. They got people in here that's been working for 20 years. You feel what I'm saying? 15 years. All that stuff is good. All right. Average age, 57 years old, 3.9. All that stuff is good. Board members here, you can see the boards. So this website makes it so much easier. Ownership, insider trading volume, very important. Within the past 3 to 6 months, you see that 23 million shares have been purchased by 2 individuals within this company. All right. 7,371 shares have been sold by one company that was invested. All right, in this particular company. So when you see a lot of shares bought in a recent time frame, insider trading, those are good signs. Those are really good signs. All right. Recent insider transactions let you know what's been going on with people. You know, that's basically confidence in the company that they're working for, or that they work in, or what they have equity in, or whatever the case may be, letting you know what's going on. All right. Or what might come in the future. Ownership breakdown here. How much large amount of hedge funds own this company, private companies, public companies, states, governments. This is all about stability right here, letting you know the people that are in on the come up for this company. Then you got the list here as well. And then you got the regular stuff for the company. So definitely check this website out. There's a free version of this website. I have the I got the highest paid one. I thought somebody asked, are you doing the free plan or $20 a month plan? Yeah, I just paid for the year. I just went ahead and just paid for the year. And so I have unlimited amounts of companies that I can look at. They put limits on how many companies you can examine, I guess. So I just went ahead and got the unlimited plan so that I can go crazy with it and look at all this stuff, plus use the screeners. So screener, just an example for this. Make it easy for you, right? Boom, we want dividends. We want health. All right. And then we want some future growth. All right. Obviously, the farther that you put this stuff out, the smaller amount of companies you're going to get. So you got to be modest with this. Maybe I got to move this back a little bit just to give me a little bit wider range. So I want dividends, I want health, and I want future growth. Boom. Sorted all these companies out for me. All right. You made it easy for me. So now I can just focus on these right here. All right. Making sure that I'm in the US market. If there's any in there, one company that's going to give me exactly what I want. And then I have to look at the risk to see if the risk and reward makes sense. 3.92, that's a strong dividend. All right. Then I look at future growth and see what the predictions are. 93%, 39%. So that's how you make your life easy. All right, we done with that. So check out simplywallstreet.com. All right, another thing I want to do real quick for y'all. I know some people in here that have TD Ameritrade. Well, the dope thing about TD Ameritrade, I can't really speak on too many other brokerages. All right, but I'm gonna tell you one thing. There's two different things that you can do when we talk about planning, right? Back to the previous class when we talked about risk management and financial planning. How many of y'all actually know what your expenses are for the year, like stable? You know what I'm saying? Fixed amount of money that you're spending every single month. By now, everybody in here should know how much they're spending every month and how much they're spending every year. The fixed amount. Everybody should know that, all right? You got that number. Okay, cool. We're working towards getting that amount in passive income. Also, you need to have in mind, how much money do you want to be spending? Is it more or is it less? What lifestyle do you actually be wanting to live? Like, what do you want to do? What do you want to have? What type of lifestyle do you actually want? You have to know that. If all you want to do is travel for the rest of your life, you need to know how much money is it going to cost for you to travel for the rest of your life every year. How much do you need to be spending to travel and go all over the world? You need to know that number. If you just want to have a bunch of land and a mansion and all this other stuff, you need to know what that number is so that you have it in your mind and you have it on paper. How much money do I need to be bringing in every single year to accomplish this goal? And then you need to have the strategies to work towards accomplishing that passively. We don't want to have to work to achieve those goals. We want to be able to get those goals without having to work. So you need to have that number for what you're doing now, and you need to have the number for what you want to be doing in the future, okay? Two things that you want to look at. Dividend.com. There's a calculator that'll let you play around so you can see how much you're predicted to get in a year. I'm gonna do a demonstration so y'all can see how crazy this is. A lot of people look at this and be like, man, I need millions of dollars in order to get what I'm trying to get. That might be true, depending on where you're starting from, though. So if you're starting late in your life, then maybe you'll need more money. That's obvious. But if you're starting early, maybe not so much. You just have to do it strategically in a way to where you're investing every single week, every single month, every single quarter, however you want to do it. Me personally, what I do, every single week, my goal is to purchase 100 shares of something. We're talking about a 52-week period. Most of the time when we pull up these charts and we pull up these financials and we're looking at these companies, there's always going to be a 52-week time frame. You see that a lot. So what I did to make it easy for myself, I said, out of 52 weeks, if I invest and I buy 100 shares of something, by the end of that 52 weeks, I'll have 5,200 shares of something. And every single security that I invest in, absolutely 100% pays dividends. And as for right now, I'm not looking at no companies that pay less than 4%. period. I don't care what's going on. I'm not investing in no companies that pay less than 4% dividend payment. And I'm getting 100 shares of something every single week for 52 weeks straight. If I accomplish that, I'm gonna do the same thing next year. Same thing next year. Same thing next year. So let's go ahead and do an example. All right. What I have right here is a TD Ameritrade income estimator. Okay. Let's just say, for instance, a couple of stocks that I actually do have right now. AT&T, ExxonMobil, People's United Financial, and let's throw a REIT in here. Let's do a REIT. Now I gave you a list of 86 and I gave you another list of 20 something, whatever. You don't have to get every single stock on here. I advise you to diversify and get at least, different sectors, but just be smart. Yesterday we talked about energy, right? That's a big thing going into the future. So make sure you got something with energy in there. It's 2021. We're dealing with tech. Make sure you got some tech in there. You feel what I'm saying? Just be strategic about how you do it and look at what's going on in the future. We got Biden in office. Pull up some of the articles where Biden was talking about some of the things that he was going to focus on while he's in office. There's different sectors. So go at every sector that he said he was going to focus on. He's going to be in office for 4 years at least. So if you're going to dedicate 4 years to specific sectors, then it would behoove you to get shares in those specific sectors so you could take advantage of the potential growth. Plus, you could go to the website that I just showed you and pick out the companies that have growth. They're going to be in different sectors as well. So just be smart about it. If you want to just play it safe, then just use the Dividend Aristocrats and Dividend Kings list so you can just play it safe. But pick the ones that got the good yield. All right, so we look at a yield. What's this, car? I don't know if I would invest in car right now. I think they're struggling as far as their situation, but just for the sake of this example, let's plug them in because they pay good dividend as of right now. All right, so 100 shares of Exxon, 100 shares of AT&T, 100 shares of People's Financial. Did car go in here? Car. Why is it? Oh, all right. So we ain't doing that. All right, let's go back to the list and pick something else. Let's pick something else. What else we got? What else we got? We need something with good NWN. NWN. All right, let's rock with NWN. 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 Boom. All right, cool. So we got this. So this particular portfolio right here is going to give me a 5.62% return on my money. All right. I invested $14,593. Probably less because we're using the strategies that we understand with fundamental analysis. So every time we purchase the stock, we actually bought it for less than what it's selling for. So this number, this 1453 number, we could probably trim that down to probably like 13,000 because we understand the market and we know how to get in at the right times. So we might be dealing with like 13,000 for real. But the value of our portfolio might be 1,500 more than what we actually spent. So we got 1,500 off top. What we do with that 1,500, we put it right back into the market. All right. Then we get dividend income off of these companies. Estimated monthly income, $68. Nothing crazy. But remember, we're going to reinvest all of this money. So after the end of the year, we collected $820. Nothing crazy. Maybe that might pay a bill for you, maybe not. But the fact of the matter is, we're not going to actually spend that money. We're going to put that right back in as a dividend reinvestment plan. So let's pull up the calculator. All right. We put $14,593. $14,593. Okay. Our return was 5.62. 5.62. How long y'all want to do this for? How long do y'all want to hold this portfolio for? Somebody throw me a number out here.
5 years.
5 years, that's it?
Just throwing a number out.
All right. Let's do 5. It's 5 o'clock. Let's do 5. My bad. I don't know why my music just came on. 5. We're gonna do 5 first, and then we're gonna do 20. 5 years. At the end of 5 years, that's your return, 5,000, and it grew from $1,000. You didn't have to do nothing. All you had to do was invest your initial investment. Not to mention the fact that we're going to continue to invest in this with our own money, but without putting nothing else in, not going out of pocket at all. No more. Just what you got right here. And we're not even talking about the potential growth that's going to happen in the company. And we're not talking about the potential dividend payments that are going to increase because we strategically invested in companies on the dividend kings list that increase. So the dividend payment is going to increase in every year probably. So you got growth that isn't taken into consideration on this. You got an increase in dividend payment that isn't taken into consideration on this. And you got more investments that you're going to continue to do on top of that. This is just if you do the dividend reinvestment plan, the DRIP. So in the end of 5 years, you'd have made $1,000 by not doing nothing. And then you come out of there with a $19,181. Let's do 20 years. And obviously we know the longer you hold, the more money we talking. You see what I'm saying? You invested $14,000. 20 years later, you walking away with 43. Obviously, we know that number is going to be bigger because we're talking about growth in the stock price. We're talking about growth in dividend yield. All right. And we're talking about potentially investing more money as we go. But let's just say we put up 14 and that's it. And we let it sit for 20 years and we just watching the market, watching it, making sure it's going up, making sure it's going up. 20 years later, we sitting looking at $43,000, a little over $43,000. All right. Do y'all understand how this works now? Do y'all understand that?
Yes.
Yes, I understand. I want to ask you a quick question.
Yeah.
What about the companies that don't have a drip plan and you have to do it upon yourself? How do I go about that?
When you get your dividend payment, you just take the dividend money and you just buy more stock.
Okay, how is that given back to me? Is it in the form of my share growing, like from maybe?
Nah. So if you're not doing the drip, they're gonna pay you. Like, let's say for instance, you got your brokerage account. Let's say you're doing it with Robinhood. Robinhood's gonna send you that money. It's gonna go right to your buying power. If you got traditional brokerage account like TD Ameritrade, you can elect for them to send you a check in the mail. Okay. Or they just throw it into your cash value in your account. And then you can take that money and do whatever you got to do with it.
Gotcha. Okay, I didn't know. I thought maybe the stock will increase or something. The stock price will increase.
If you have the drip on your account, usually a lot of companies will actually give you a deal on the shares that you're gonna reinvest anyway. So you're gonna end up saving money and making money at the same time if you put the drip on there. But again, you know how to trade now. You know how to chart now. You know when to buy at the right time. You don't have to put the drip on there. You could do it manually. So that way, when you get your money, you want to make sure that you get the most bang for your buck. You pull up the chart and you see where the dip is at, and then you buy at the dip, and then you get even more growth. You could do it like that.
Okay. My long-term investments is not in Robinhood. It's in E-Trade.
Yeah, that's why I suggest people do that. But it's a whole lot of people that use Robinhood, and there's nothing wrong with it. I just like having a more traditional brokerage account because the beneficiary situation. So if you have kids and you have wife, husband, whatever the case may be, something happened to you, you want to be able to to make sure that they have the ability to get your portfolio transferred over to them. And Robinhood's not going to do that for you.
Gotcha.
Yeah. Heaven, you have a question?
Yeah, it was basically regarding that, because I was gonna say, so would you even do any sell calls through Robinhood? Because you're trying to get the shares, but you're saying that in the long term, like it's not going to benefit you if you wanted to have your child or beneficiaries.
Yeah. So for me personally, when I'm doing sell calls, I'm doing those. If I'm doing it on Robinhood, I'm just doing it for cash flow. Period. So if I'm serious and I really want those shares, then I'm not doing it with Robinhood. I'm gonna do that with a traditional brokerage account. Because I want those shares to be in a traditional brokerage account for all the reasons that I stated before. And to be honest with you, I don't even write cover calls on the shares that I have in my traditional brokerage account. I just let them sit there. I don't do nothing with them. I don't really make a whole lot of different trades and using a bunch of strategies and stuff like that in my traditional brokerage account, because they do have commission fees, and Robinhood doesn't. Plus, the only thing that I do as far as options is concerned is I always buy the shares through an options trading strategy. I just don't do that cover call writing stuff on there. I buy a call, and then every now and then I might get a cash secured put, but normally I just buy calls in traditional.
Thank you.
Yeah, no problem. Anybody else got questions?
I have a question.
Yeah, go ahead.
So when we talk about selling puts, right? The
Mhm.
buying power, does it have to be equal to your buying power or available balance? Does it have to be equal to the strike price or the contract amount?
Oh, repeat that one more time.
Your buying power, the amount of buying power that you have available, does it need to be, so for example, if you were trying to sell a put on 100 shares at 43, then you'd have to have $4,300 available in buying power, correct?
Yeah. So
That was the strike
whatever your strike price, you have to have that amount times 100 in your buying power.
Okay, that helps, because I put a question out there in the chat where I was trying to set up a naked put on Mara, and it wasn't going through, but now I understand why. Because my buying power, I had enough to cover like the what's the amount that you typically would get an option for, but not the actual strike price.
Yeah.
So it has to be equivalent to or more than the strike price.
Yeah. So
Okay.
sometimes also you gotta pay attention to that too, because sometimes your balance might be one thing, but your buying power might be something different. So just make sure that your buying power is available if you're doing sell puts or naked puts or cash secured puts. You have to have the buying power, which is the share price. The strike price multiplied by 100.
Okay, got it. Thank you.
All right.
Selling a put is more risky than buying a put, right?
No, because I mean they're both equal to me, but selling a put is just putting you in a situation where you're getting money up front. It ain't you getting money up front and you have an opportunity to get the actual shares. If you're gonna buy a put, then you don't want the shares. Normally when people buy puts, they don't want the shares. They just want to profit off of the downfall. They just want to bet against the company because they know that it's going to go down, and they're just trying to profit off of that. Normally, that's what you're doing. When you're selling a put, you're trying to get premium up front first, but you're getting the premium up front because the other person that's selling it to you, it's an incentive for you to take them shares. They don't want them no more. So it's like you want the price to actually go up. If you don't want the shares, you just want to make the money. You feel what I'm saying? if you think the price is actually going to go down, then it's like you're betting on yourself almost. Like you're getting paid to be right about your prediction. So if the price actually meets your strike price and you get exercised and you get the premium, it's like pat yourself on the back. You was right, but you could have just you know what I'm saying, you could have did the same thing with buying a call or whatever. You know what I mean? So it's just about getting the money up front. Only selling calls and selling puts will allow you to get the money up front. That's just the advantage.
Gotcha.
Yeah. Anybody else got questions? All right. So in a nutshell, today's class, what I really just wanted to get through to everybody was so that you could visually see how simple it can be to map out your future financially. All right. If I just use an example and say, my expenses, let's see, my expenses might be like $3,000 a month. Multiply that by 12, that's 36,000. I spend $36,000 a year just to live comfortably. My rent, my mortgage, my car note, my insurances, my utilities, all of this stuff. It takes me $36,000 a year. All right. You could look at this thing one way or the other. You could look at it like, okay, either I have to minimize my expenses, you know what I'm saying, or I have to figure out how long it's going to take for me to invest to reach that goal of financial freedom. How long is it going to take for me, and what sacrifice do I have to make in order to bring $36,000 into my life passively without working? So it might be a yearly goal. It might be a decade-long goal. You have to make that decision. But the easiest way to do it is to look at the companies, look at their yields, look at the future and where you think economy's going and where you think things are going, and minimize your situation to where you're at least hitting those important sectors, and then you can just maximize the rate at which you invest by putting yourself on a plan. Whether you want to do what I'm doing, where you investing in 100 every week, or you invested every 2 weeks, 100 every 2 weeks, or every 3 weeks, every month. However you got to make it happen, just get started, because the quicker you start, the closer you're going to get to achieving your goal. So if we just go off of the example that I did right now, and just keep it at that, how long will it take for you to do that? Now, obviously, these prices aren't going to stay the same, but that's why we understand technical analysis, because we're going to make sure that we get in at the right times. We make sure that we buying at the right time so we can get that growth. And then if you want to take some of your growth and sell off some of your shares, and then take that cash and put it into another vehicle, you can do that too. You understand how to do that. It's not that difficult. But if we just use the example that I went off of, you know what I'm saying, it might take you a little while, but at least you're getting closer and closer. Now, every year, you're getting closer and closer to getting the returns. You dig what I'm saying? So the return is here. Now, as you get older and as you get wiser and as you continue to invest, that's just more money that you don't have to spend. So you can look at it like this: 4 years later, I'm gonna make $3,500 extra, or 4 years later, I'm gonna make that's $3,500 that I don't have to spend. I look at it like that's $3,500 that I don't have to spend. That's $3,500 that I can take and reinvest and speed up this process. So you can look at it like this is money that I'm going to take and spend, or you can look at it like this is money that I'm going to take and put right back into my plan and speed up this process, potentially cut this thing in half. If you knew this information when COVID first hit and you saw that big dip, just imagine what you could have did with let's use who bounced back like crazy. I don't know. Let's I don't think Verizon's there, Dropbox, Dollar Tree. I don't know. Let's use Dollar Tree for example. All right. Just look at the dip, like October. Where we at? What's this? January. Boom. Here or here. Either way, October, they gave you another opportunity. Price dropped all the way down to 60. You know what I'm saying? Imagine if Dollar Tree was paying 6% or 5% yield on their dividends and you invested here. Look at all the growth that you would have got into. All this growth plus the dividends. You might have shaved like 2 years off of your investment plan by making a move like that. You know what I'm saying? Just for the sake of argument, if we look at the SPY, just for the sake of argument, look at this V-shaped recovery. Most of the companies had this type of situation. What you think the rich people did when COVID hit? Do you think they was sad or do you think they was happy as hell? Then we can get into the conspiracy theories and all that, but at the end of the day, the people who have this knowledge, they had the knowledge about what they had the knowledge back here. They knew that it was going to be a market correction. If you understand the market, you know it's going to be a correction. You just want to know how big it's going to be. We knew this already. You know what I'm saying? The mentor that I had a few years ago, he told me that it was about to be a stupid correction coming. We didn't know there was going to be COVID, but he told me, bro, get your shit together. Get your shit together now because it's about to go down. Fast forward a year later, this thing dropped like crazy. What you think the smart money did? They bought all of this right here, and then if you would have started here, you would have shaved probably 10, 15 years off of your investment goal just because you was ready to take action at the right time. And then you got all that growth, you got all them dividends. You know what I'm saying? Sell off some of your equity here, reinvest, you know what I mean? Reinvest in other assets in different industries, spread it out, diversify, whatever you got to do. But at the end of the day, you're putting yourself closer and closer and closer to achieving your goal. Now, your goal was 30,000, 35,000 passive income. Well, shit, you can get that. It might take you 17 years if you just invest this and that's it. But if you keep investing and you're using the options trading strategies and you creating passive income and using the put strategies and you know experiencing all these gains off of these earnings calls and you taking advantages of these dips and all that 17-year mark, that shit is irrelevant. You probably looking at around 9 or 7 to get that. It ain't gonna take that long. We just looking at this from the perspective of that's all we're gonna do and that's nothing else. That's it. You feel me? So I just wanted to lay that out for y'all so y'all know how easy it can be. Yes, this is a lot of money, but it's not really. We have people in the Telegram that made $1,000 in a week. You just got to make the right moves, and then you got to know what to do with your gains when you get them. All right. So we're gonna wrap this up. If anybody got any questions, y'all can go ahead and ask now. But we can go ahead and wrap this up.
Just go. Say something.
Hello.
Yep.
Hey, quick question.
Mm-hmm.
When you know the tool in which you use looking at the rise and fall of the stocks, when I log into Robinhood on the computer, how can I see it
The measuring tool.
in this format like you have it?
This right here.
Yeah.
What do you want? What do you want to see now?
The tool in which you use to measure. Yeah.
You talking about the Fibonacci retracement tool?
Yeah.
Yeah. So you want to go over to the left side where your toolbar is at, and then you want to click. This should be the third option, and you got all these options down here. You want to scroll all the way down till you see Fib retracement.
Okay.
All right. If you click this star right here, it will actually add it to a toolbar here, so where it's quicker. You can get to all the stuff that you like. So you have it all here in the toolbar right here. So you ain't gotta keep going to the side and trying to find it and all that. You just click the star and it'll create a toolbar for you right here. But it's the fib tool. Now, I sent a video into the Telegram group of what my settings are, but since we on here right now, I could just pull them up. I could throw the fib on here, and I want to use it. This has an opportunity to do it the right way. All right, we're gonna go from swing low to swing high. All right, and you see my purple line. My purple line at the bottom is 100%. My purple line at the top is 0%. I'll be calling that 100%, but whatever.
Okay.
And then my settings are here. All right. So for those of y'all who trying to get yours to look like mine, here's my settings. Okay. So I got 0, 0.382, 0.681. These should already be here. 0.5786. Those should be there already. One. But then I added negative 0.27. And then I also added negative 0.618. All right. The reason why I added these two and left out the 20, I think it was the 23% level. I took that out. The reason why I did that is because I never take trades off of the 23% level. I never take. And normally when a price is actually retracing, it normally doesn't never even stop at that level. I don't even think you should consider price jumping off the 23% level as an actual real retracement. It's like irrelevant. So I took that out because I normally take trades off of the 50% and the 38.2. That's normally where I enter at for long trades. So I took that out, and then I added the negative 27 and the negative 61 because as an extension, when I'm actually trading and I'm trying to be conservative, my price target is usually at this 0% level. But traditionally, when you're using the Fibonacci retracement tool, the extension level is normally where you want to have your price target at. So the extension level would be negative 27. All right. So if I'm taking a trade and I'm taking a long position, all right, and I put my fib on here, if I take a long position and I want to enter at the 50% level, my price target, if I'm really, really like honestly believing in the Fibonacci retracement tool the right way, then my price target should be at least the negative 27% or the 27% level. All right. That's a good price target if you're using the Fibonacci retracement tool. And as you can see, price hit it right on the money and even went beyond it. So the next level is 618. And that's pretty much where price is getting to right now. So if we would have took a long entry in on SPY back in October 29th, we would have been sitting real nice right now because we would have got all that gain. All right. So that's how you use the Fibonacci retracement tool for long entries. And then for short entries, SPY probably wouldn't be the best example to use, but we can still use it. All right, short entry here. You want to go from swing high to swing low. All right, which is this point here. We just extended it out. Boom. Price retraced all the way back to the 618. I would have entered short at the 50% level. Short entry at the 50% level. Had my stop loss here. And my take profit would have been at the extension 27. And boom, my price target hit. And it actually went beyond to the 618. All right. So you can see that Fibonacci retracement tool fits perfectly
Like this.
on SPY. All right. Another thing that I know I had some people in here, y'all supposed to remind me. A strategy on easy cash flow, right? Easy cash flow, no risk, no stress. Don't have to worry too much about dealing with this and that. Easy way for you to make some easy money. The put credit spreads. Put credit spreads. So we're looking at SPY right now.
Hey, bro, thanks, man.
Yeah, no problem. We're looking at SPY right now. All right. SPY is going up, 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 up. That's all it's doing. Yeah, it had a retracement here, but for the most part, it's going up. This is an ETF. It's designed to go up. The strongest companies in America are in this particular ETF. So it's designed to go up. Any company that is in this S&P 500 that's failing is going to get taken out and removed by a stronger company. That's how they operate. So it's designed to go up. And not only is it designed to go up, but throughout the day, you see these super small candles. There's not much price movement throughout the day. You know what I'm saying? It's not going to be that big of a percentage of a move throughout the day. So what that means is you can use a put debit spread, a put credit spread to gain passive income every couple of days. So let's look at the SPY option chain. You pull up the SPY option chain, look how many contracts they got per month. February 26th, February 24th, March 1st, March 3rd, March 5th, March 8th, March 10th, March 12th. Look at how many expiration dates they have per month. It's like 12 expiration dates per month for SPY. What does that mean? That means you can get paid damn near every 3 days. And if you're using the put credit spread, you can do it in a way to where it's low risk. So let's do an example real quick. All right. Sell put. Expiration date, February 24th. All right. The share price is at $389.60. Let's pull it up on the chart. You see the chart, right? What's the likelihood of this price going all the way down to 370? Very, very slim. Within a 2-3 day period, I don't think the price is going to drop that low. More than likely it's not. Now, you've seen in the past that it's capable, but not in 3 days. It took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It took damn near a whole month for the price to drop that low. So you could sit here and say the next time price tests the 50 moving average, it's going to take a minute. Now, it looked like it might be shaping to come down, but it's going to take a minute to get there. So let's look at the chart and say, okay, 366, that's a safe price. Matter of fact, you can go beyond that and pull up the pivots and go on the monthly pivot and look at the support level. The support is all the way down at 363. The pivot is at 374. So you could take that information, take it over to the options chain, sell, put, go all the way down, what we say? Pivot was at 374, support is at 363. Let's go down to 374. 374. Now, you know price ain't gonna go all the way down to 374. So I could go ahead and buy one. And now I want to do a put credit spread. So I'm gonna go sell put here, and then I want to buy a put here. Put credit spread. All right. Continue one contract. I make $2. That's not a lot of money. It's not a lot of money, but it's passive income, and I only had to put $100 up. Now, that's a large gap between price now and the projected price, which is why the minimum credit is so low. But let's make it closer. Let's say we don't think price is going to go down to 384 because it's SPY, it's designed to go up. It might continue to go up. Let's say we don't think price is going to drop to 384. Pull up the options chain. Take it back, erase, boom, boom. All right, we're going to go sell put, and we said how much? Resistance is at 384. So 384, expiration, February 24th, a couple days from now, 3 days from now. All right. We got one, buy, and then we got 383. Put credit spread, $13. Ain't a lot of money, but look how much you putting at risk. You only putting $100 at risk. So again, it's not a lot of money, but you're only putting $100 at risk. So you're getting a 13% return on your investment. Remember, I always talk about ROI. ROI is the most important thing. So you're getting a 13% return on your investment. Let's turn it up. Go back. Let's turn it up. Let's do 5 of them. Matter of fact, let's do 10 of them. We got $130 collateral. That's $1,000 collateral. You make $130. It's like almost a sure bet because you're dealing with a stock that doesn't move a lot and it's designed to go up. You're getting contracts predicting that it's going to go down when you know it's going to go up. So you're not going to get exercised. You're just collecting cash flow. This is for the people who don't want to risk the huge movements when we're dealing with earnings calls and stuff like that. All right. Obviously, you know, it's about how much you want to put at risk, but this is an option for you. Now, people are out here literally quit their jobs just to do this full time. Depending on what type of job you got, I'm not telling you to quit. I'm saying there's people out here who have figured this out and say, hold up, you mean to tell me I can make cash flow I can get paid every 3 days. And all I gotta do is stick with SPY and just do put credit spreads every 3 days. And I can just make money every 3 days, knowing that the price ain't gonna go down. And if it does go down, let's just say, for instance, the price does go down, look how much you put at risk. You might lose like $40, $50. But the averages of it actually going down versus it not, you might lose 1 out of probably 9 or 10. So you might lose 1, but look how much you made by the time you lost 1. You know what I'm saying? So you just risk and reward. So this is a safer thing. This is what I was talking about when I said it's another way that you can invest. Whereas normally, if you wanted to get, if you wanted to sell a put, you would have had to have $38,000 in your account if you want to do a put. Or if you wanted to buy a call, you would have had to have $372 for 1 call, and just to get some profit off of SPY. You ain't got to do that. You can put $100 up and you can make $13, 10% return on your investment. It's better than sitting in the bank. Better than sitting in the bank. That's all I'm saying. All right. So there you go. Put credit spreads. And only do this with stocks that go up and they don't have much movement. Do not try this with Tesla. Tesla moves way too much. You feel me? Do not do this with no stock that has a lot of movement within the day and it goes up and down. You want to deal with stocks that are going up. So SPY, QQQ, Amazon, those type of companies that don't have much movement throughout the day and they're just designed to go up, you only want to do this with those type of companies. But SPY is dope because look how many expirations they got. You could get paid 12 times a month by doing this. All right. How would you go about selling the put spread? What do you mean by selling it? What do you mean by selling it? You mean like buying it back? Let's say, for instance, if the shit hit the fan and it starts going against you, and you're like, damn, man, this joint going against me. You can actually buy it back. So you buy it back. If you put $100 up in collateral and the shit start going against you, then you could buy it back. You might come out of pocket like $14, $15. So you might have lost a little bit of your money. It's just a better way for you to have better risk reward ratios and just low risk in general. Just low risk in general. But it doesn't get, it's not like you get exercise and you're getting shares. You're not getting any shares. You're not getting anything. All you getting is you either making money or you losing money. That's it. And this shit is designed so that you make money every single time. I just told you, people not retire, but quit their jobs and just do this full time. I mean, let's just do the numbers. Like what we said, we could just go down here and be like, man, we know SPY ain't gonna drop all the way down to 375. You know what I mean? We do one, and we do one, and we say we want there's people that got $100,000 in your 401k or your IRA or whatever the case may be. You might have 100,000. I have friends that have $100,000 in their Robinhood account right now. So if they just did this, they could make $3,000 every 3 days. Every 3 days, you can make $3,000. I'm just giving you examples of what's possible. All right. So that's, you know, people talking about having envy of rich people and whatnot. I can see why you would be envy of rich people if they have access to this information and you don't, and they got the money to do it and you don't. They don't have to do nothing. They don't have to do nothing. And this is Robinhood, but you can do this with any platform. It just looks easier on Robinhood, but you can do this with any platform. All right. Does everybody understand that?
Yes, thank you so much.
Yeah, no problem.
Yeah. Hello?
Yes.
So on the mobile device, like what you're doing right now for the put credit spread, is that, are you able to also do that on the mobile device, or do you have to actually be on like on a computer, like a laptop or like a desktop to be able to do it on that style of trading?
No, it don't matter what you got. Mobile device, cell phone, iPad, tablet, it don't matter. It's all the same.
Yeah,
Because Robinhood is just an app. So it's designed to be with mobile devices anyway. But
yeah,
it's just easier for me to show you on the computer, but you can do this with the phone.
yeah. Because actually I'm just playing around with it as you're doing it, and I'm on my cell phone. So how would I be able? Because like it's not giving me that option to do like what you're doing. Like it's only either one. Like if I do like the sell and then the call, it doesn't give me the option to do like the spread as well on the mobile. That's
So
what I asked that question.
you probably need to go back into your settings and look and
Uh,
see what you're able to do, because again, options is not something that's available automatically, as well as the spreads. So there's different levels of options trading that you have to
okay.
be able to do. You feel me? So you have to upgrade the let me go back so I can tell you exactly. So what I'm on right now is I'm on level 3, options trading. Go into your account and then click investing and scroll all the way down and it'll tell you what level you're on. I'm on level 3. So on level 3, it allows you to buy and sell spreads. If you're not on level 3, then you're not going to be able to do this.
Okay, that makes sense.
All right. I'm glad you said that. So everybody knows if you don't have level 3 enabled on your options trading, then you're not going to be able to do this. My man Daryl said this is crazy. It is crazy. And I didn't want to tell y'all this out the gate. I needed y'all to understand the basics first, because if you mess this up, you know what I'm saying? If it says anything other, and Robinhood is dope because they tell you what you're doing. If it says anything other than put credit spread, then you did something wrong. Also, you don't have to select them right under each other. You can actually go lower if you want, but it's more risky that way. Even though you're gonna spend less money, it can be I mean, you're gonna spend more money if your spread is big like this. All right. But you know, I wouldn't advise you to do that. It's really not necessary. Just keep it simple. Just keep it simple. You feel what I'm saying? Just keep it simple. Now, again, for the people who got a lot of money to play with, you see this credit, $8,000, multiply that by 12. Because that's how many contracts that SPY has per month. So multiply that by 12. All right. And you're looking at potentially getting $96,000 a month doing this shit. You double your money. So it don't matter how much money you got. You can start with $100 or just start with $5,000, $500, $5,000. Just if you just keep doing it every single 3 days, then you're just gonna compound your money. Compound your money. Now, what do you do with the compound? Invest it in long-term assets and grow your portfolio so that you have passive income. Now you don't even have to do this shit no more. You just making money just sitting there and you good. It ain't that hard, ladies and gentlemen. I made it easy for you. All right. So I'm about to wrap this up. Heaven, you got a question?
No, you answered everything. Thank you.
All right, no problem. Anybody else?
I want to ask you a quick question.
Go ahead.
Late to put a put option in on what's going on in Texas, the oil prices.
Yeah, I spoke about that on Instagram Live. I personally didn't do it, but I gave that out. I called that out for people because it was obvious. All right, BNO. I don't know how low it's going to drop, but this short period right here, you could have definitely made 1,000 or so right here. You know what I mean? But well, let's see what happens tomorrow. If this price continues to drop, then we know what time it is. But it looked like they're starting to get their shit together in Texas. So I don't know how long it's going to take for them to get back to normal. But until that time, you can pretty much bank on this stock dropping a little bit more.
Okay, I took one out on Friday.
Yeah. Okay.
BNO or something like that.
BNO, yeah, that's what we're looking at right now. So BNO, yeah. And then on the flip side, we looked at what was it?
NEE.
Yeah, we was looking at NEE. So this the one we're looking at right now. This the one we trying to see what, where this thing is gonna go. So market opens up tomorrow. If the market opens up tomorrow and price opens up higher than where it's at, I got my alert set. at $38.32. If price rejects this support level and goes up, I'm probably gonna go in for a call. And I showed y'all what the profit calculator is looking like. The profit calculator is looking crazy for NEE. I can do that now. I know a lot of y'all probably didn't see that. Let's look at NEE real quick. All right. So we said we was looking at a potential, 70, 75, I think $75 strike price. Buy call 75 or 775. Any one of these will do you good. Expiration date though. So I said June 18th. Why? Because I put the measurement tool on it, and I said I think the date range on this going from here up to a previous resistance level or 100% level on the fib, probably like 53 days or something like that, 56 days. So I need at least 60 days on my strike. I put it out to June 18th just to keep it safe, So we're looking at a $510 investment. But for this one, if price rejects, I might have to go ahead and put 1,000 on that, because we're looking at potentially. Let's just go ahead and do it. NEE. And I'm not telling y'all to do this. I'm just saying, like, you gotta do your own risk management. All right. So we got 510, 2. All right. Calculate. On this calculator, this is crazy. So if price goes all the way up to a previous high at $87.71, $87.71. We're looking at anywhere between here and here. All right. This is what the potential profit could be, but you have to give it time. You have to give it time to get up. So we're talking about, 3 months from now, possibly. But shit, I put $1,000 up. 3 months later, I turn around and get 100% return on my money or more. I say that's a pretty good situation. I don't mind holding that. What else I'm gonna do with it? Sit it in the bank and just double my money. Then I'll take that $1,000 gain and I'm gonna buy some more shares with it and just keep growing my portfolio. But again, that's just a play. You don't have to take it that far. If you got $1,000, you could just do the put credit spreads and just do it like that if you want to do it. I don't do it that often. You know what I'm saying? I do put credit spreads. I just don't do them that often because I don't know. Maybe I just like making my life a little harder or whatever. But I don't know. Sometimes I want the action. Sometimes I just like risking shit. But for those of y'all who don't want to, you want to play it safe, then you might want to try to put credit spreads. If you need help, just let me know. All right. We good? We good on questions? Yeah, the Zoom is recorded. So it's gonna be in the back end in a couple hours probably. So y'all be able to go back there and watch the recording. All right. All right, I appreciate y'all. Again, make
Appreciate
sure
you a
you
lot, man. Again,
yeah. What you said?
said I appreciate you a lot.
Yeah, for sure, man. I appreciate y'all for joining. Make sure you go to the members area and get these lists. Dividend Aristocrats, Dividend Kings down here, High Dividend Premium list is here, Options Trading Resources is here. I will update this Aristocrats and Dividend Kings list pretty soon, but for now, it's cool. You see what's there, you see what's available. You could just go ahead and plug it in your chart and plug it in your brokerage account and do your own due diligence on them. But they're the list there for you. Make your life easier. Plus, make sure you check out the Simply Wall Street website so you can get all of the information and make it easier for you. If you're not comfortable using finance, Yahoo Finance, then we introduced the dividend.com compound reward calculator. Plus, if you have TD Ameritrade, you can play around with your income estimator and give yourself a plan. Print it out, put it on your wall, put it in your office so you can look at it and see what your goal is, man. I feel like everybody in here should be making enough money to invest 100 shares into something every week or so, and if you're not, then you need to get it yourself in position to where you're using these strategies so that you have some income so that you can start, because you need to start. You need to start ASAP. All right. Appreciate y'all, man. Y'all have a good night.
You too. Thank you.
Thank you.
Thank you.
Thanks
Thank
again.
you. Yep, thanks.
Appreciate it.
Peace.
Thank you.
Thank you. Bye.
Thank y'all.